When you look at nickel and platinum and the like, those are weaker. So we'll watch the miners. Guy.
Okay, here we go. Time for Friday's session. Europe's going into this session basically looking at the rearview mirror, because we're watching what we saw yesterday, the back end of the US session, and that's going to dictate what happens going forward in the next few minutes, I suspect, here in Europe. So the London market, always quick out of the gate, is a little softer. We're expecting most markets in Europe to be down by 2–3% We're not quite there yet. London seems to be maybe holding up a little bit better. These aren't big moves, but I think there's a little bit of many risks going into this weekend as you watch what happens in Iran, what happens in Japan. All of these kinds of factors, I think, firmly on the minds of a lot of portfolio managers this morning. So there you go. FTSE 100 down by 0.2%. IBEX is down by 0.3%. That was the narrative we were expecting. Tom, sectors.
Yeah, in line to your point, in line. The index is in line largely with the futures and the signalling there. Across your sectors, healthcare is at the top of the list so far. Technology not far behind, 0.2%. ASML's doing another bit of lifting for that sector. That stock up 1% on the back of that upgrade then. Healthcare then up 0.3%, tech up 0.2%. Those are the two leading sectors right now, but most sectors are in negative territory, not by a huge amount. Basic resources, again, as we expected, currently is the leading loss coming through for that sector, down 1% because of the price pressure coming through for iron ore, but most notably copper in the session today. Anna, what is catching your eye?
Yeah, just some of that metals trade. I mean, basic resources by far and away the worst performing of all those negative sectors this morning, and some of that obviously explained by the moves that we've seen in the base metal prices. Boliden is over in Stockholm is the worst performer within that sector. That's a base metals business. So whatever is today's driver of the weakness that we're seeing in some of those base metal prices, that is certainly something that is having an impact on markets this morning.
What do you do going into this weekend, though? What does the end do? Big potential moves there. Jane Foley flagging the possibility of joint US-Japanese intervention. How big a risk could that be? What happens on Iran? Is that for next week? Do I basically just have to track the USS Abraham Lincoln, is it, that's moving out of Asia into the Middle East and keep an eye on what's happening? I don't know. It's fascinating to see. In terms of the points, SAP, Richemont's, this is on the downside, SAP's down. Richemont's backing off after yesterday's move. But then it's kind of a mix of Rio Tinto, some banks, and some of the big oil companies just kind of moving a little softer this morning. Yeah, let's talk about these markets then. Patrick Armstrong joins us, CIO at Plurimi Wealth, on set with us this Friday morning. Welcome to the programme, Patrick. Middle of January. Feels maybe like the end of January, or even the end of a year. It's been really busy. Where are you thinking about risks right now? What is the risk to the US economy right now, Patrick? Is it to the up or the downside, do you think?
Risk is to the upside. I think Trump, everything he wants to do is create huge momentum going in through the summer, create short-term fixes for all the problems he sees, and will suffer the long-term consequences after the midterms. And I think that's as far as his vision goes. He really wants everything to be great for the summer, so he wants to politicize the Fed, get interest rates down towards 1%. You're going to get tax rebates coming in the next few weeks, and then you're going to get a tariff dividend going into the summer. So it's fiscal thrust, monetary thrust that's not needed. I do think pushes the economy higher, pushes demand higher, and you probably fuels a bit of a speculative frenzy.
Okay, yes, I mean, you can pick your metaphor. You talk about a sugar rush. We would have previously talked about a punch bowl, perhaps, you know, being liberally provided for this equity party. So, what's the risk what tips that over, do you think, into something more negative for stocks?
So the
maybe that's
politicized
long
Fed,
off. Maybe that's far away.
So my thesis is you need the Fed to cut. You need monetary stimulus combined with the fiscal stimulus, given where valuations are. It's not completely easy to politicize the Fed to the extent he wants to. He might succeed. He may not. You may get the existing governors have their backs up against the wall and they push back against the new chairman about what he's trying to put in place or she's trying to put in place. And without monetary stimulus, the valuations, I think, discount the very positive fiscal backdrop, the very positive consumption backdrop as well. So I do think you need that extra thrust of monetary stimulus that's not needed.
That's interesting. So the Fed is still a key dynamic.
I mean, so how many cuts? I mean, how many cuts would be needed then to get to that place that you're looking for on monetary policy, given the fiscal stimulus and that push for lower prices and the
two cuts will be very stimulative before September or during September, by September. Things less than that, I think the market's going to be disappointed given where it's trading.
Disappointed. How does that show itself?
It depends on the narrative. So you're going to have Senate hearings as the new chairman gets basically questioned. You'll figure out what he's thinking, and then you'll see if he's if he can create consensus within the Fed. But there's so many other dynamics that are going to happen to have a view about what things are going to be in September. It's almost foolish to think about because there's so many twists and turns on the way there.
So my experience of toddlers is that you give them some sugar, you get a sugar rush, and then things pretty much end badly.
Yeah, so that's what I think.
Yeah, that's my experience, and I think a lot of people's experience of toddlers. Tom has much more experience right now. And not that you give your children sugar. What happens the second half of this year? Because markets are meant to be discounting mechanisms, aren't they?
Inflation happens, and the market is so complacent about inflation. So many of my peers are talking about disinflationary trends. Everything Trump is doing, and Trump's the most powerful force in the world in many respects. He gets things done through coercion, through policies, is inflationary. So protectionism, nationalism, stoking demand, stoking monetary stimulus. You have to protect against inflation. And the market says there is no inflation, and there's not going to be inflation for the next decade. 2.3% is the break-even for inflation for the next decade. It's going to be much higher.
But if Trump if Trump gets things done and he wants inflation down ahead of the midterms, isn't that also why markets might be assuming that inflation comes lower?
Well, yeah, I actually think we probably are on a downward trend for inflation in the next few months, potentially. But the consequences of all these policies are felt with a lag. And that's when you're going to start to see inflation. There's embers that are going to be burning, igniting, and then you've got a real inflation problem going into 2027, I think.
I'm much more familiar with teenagers at the moment, and teenage parties get definitely out of hand.
More punch bowl than sugar rush.
Definitely more punch bowl than sugar rush. What does the next morning look like?
Well, it's 2022 in many ways that unexpected inflation creates 2022. It kills bonds, it kills long-duration stocks, high-multiple stocks, and I'm trying to mitigate that by buying great companies that are trading below market multiples. If you look at our global...
Give me some names.
Well, I love Alphabet right now. It's trading at a market multiple, great growth. It's funding huge capex from cash flow from operations. I'm short Oracle to mitigate the risk that comes from basically unproductive capex spend. Oracle's funding everything it's doing with debt. I'm short SoftBank, which owns a bunch of non-profitable tech companies hoping for an AI bubble and a ChatGPT IPO. Those kind of things. I love companies that produce cash today and are growing rapidly today. And I like to reduce the risk by selling companies that don't have earnings and are more aspirational and hoping to get them. That's when inflation punishes the multiples on those kind of companies.
So just unpack that SoftBank view, what it tells us about what you think the winners and losers are going to be when it comes to the tech story.
Yeah, the incumbent companies have a much easier path to be winners. People trying to disrupt them and to get into their space face a lot of difficulty, especially like Oracle. They're trying to disrupt some of the Mag 7 companies, the hyperscalers. They're trying to get into that place. But when you're funding everything with debt, and then you get inflation and higher rates and credit spreads go if the economy slows, that just makes it almost an impossible task from a very difficult task. So I really think owning great companies that are at market multiples makes sense if they don't have a lot of debt. Shorting expensive companies that have aspirations but don't have the profits today makes good sense in that.
That fits with we talked about electricity prices this morning, and the fact that CoreWeave and Oracle and companies like this basically going to have higher electricity prices going forward.
And it's much more difficult for them to absorb than an Alphabet, for example, could be the argument. So Patrick, presumably, given your short positions, you think that is a 2026 story, that these companies, the Oracles and the SoftBanks of the world, maybe CoreWeaves, get really tested?
I do think so. I think people will see what I'm seeing if my base case plays out. The market doesn't wait for everything to happen. It starts to anticipate, and I don't like to be naked long when I know things are expensive. I like to have nice shorts offsetting my longs, and that's where I'm at right now. So it's a more moderately bullish view than outright bullish.
Where does it leave European tech?
European tech, we actually just shorted STM microelectronics as well. That's getting a bit expensive for us. ASML makes sense to me. It's got the dominant market position, incredible run-up, looking expensive, but those kind of stocks make more sense to me. But Europe, I like defense. I like banks.
Banks are expensive, aren't they? Price to book has gone crazy.
Yeah, I'm sticking with them. I haven't added to them in a while, but they keep growing in my portfolio just because the performance has been so good.
Rebalancing.
Yeah, and Europe has to rearm for so many reasons. There was a lull looking at a peace deal, and there's not going to be a peace deal with Russia. It's just clear to me Europe has to rearm for many reasons, and that's going to be structural tailwinds for revenues and earnings.
Does that mean that they're going to have more bonds issued? Just like what is the effect of that?
Well, that's a fiscal stimulus for Europe as well, which is part of the reason that I'm bullish on the European economy. Not incredibly. I think it's going to grow at 1.2% this year, which supports some growth. But there's bond issues from governments to finance it. The defense companies will probably issue capital as well, in terms of maybe even equity as well, but they probably may not need to. But
and is this a world where precious metals continue to do well? And if so, how do you get that exposure? Through the metal or the business?
I don't like gold. Gold, the narrative...
I've heard anybody say that for a really long time.
And
there's a but, though.
Yeah, there's a but. We just added Barrick in our global equity portfolio. Our macro fund has 25% of its equities are gold miners. If gold does nothing, the gold miners go up 25% this year. Every day gold stays at $4,600 an ounce. These companies produce huge cash flows, huge earnings. They buy back shares. They'll start paying dividends. And that's with gold doing nothing. If you love gold, you have to love the gold miners, because if gold moves higher, these stocks are geared gold. If gold crashes, they both crash. But the gold miners gold's a speculative asset at this point. Yeah. And gold miners are a better speculative
And there's always that risk. We talked about this a day or so ago. You know, sometimes when the selling comes, you don't sell what you want to sell, you sell what you can, and gold is very liquid, and so
very
sometimes
liquid,
we see that.
And you've got 100% profit if you held it for a year. It's that'll be a source of funds in the next liquidity drip.
Yeah.
How wide is that window to get exposure to the miners? Well, I mean, is that becoming a crowded trade?
I don't know if it is. If you look at the weights in the MSCI world, it's 3% probably in miners as a whole. So gold miners probably are 1%. I don't know if it's crowded. They've not really outperformed gold massively. In the short term, they have. Over the last 3 years, they've underperformed gold. So they're cheaper on earnings. I love stocks that are performing incredibly. I like to ride the momentum. They get cheaper. Like Micron. Every day it goes up, and it gets cheaper just because earnings forecasts are outperforming the share price. And same with gold companies.
Final question. If U.S. stocks even go sideways, what happens to U.S. consumption?
Yeah, you're talking about the wealth effect from the stocks? I don't know how much of a source of funds consumption. It fuels confidence.
Makes me feel good.
Yeah, it's a confidence
US consumer. I look at the latest retail sales numbers.
I don't think it matters if they go sideways. If they go down, then you get the double negative.
And that matters for the top of the K.
Yeah. Yeah, it matters more for the top of the K. That's a very good point.
Patrick, nice to see you. That was really interesting. Thanks very much indeed. Patrick Armstrong, CIO at Plurimi Wealth. Core 6 looks like this morning. Let's see how those defence names are trading. Rheinmetall a little softer, but not much. ASML is up. I think it's a Morgan Stanley upgrade in the market this morning. Shai's a little softer. Some of the more staple end of the market is a little softer as well with Nestle, but Novo's up. Novo's been really choppy this year and is up quite strongly as well this morning. There's a lot of M&A stories swirling around within the pharma space. Let's get more on an update. Jennifer Creary's here with that.
Hi, good morning. So mining stocks in the red this morning. That's after copper, zinc, aluminium prices all fell in Shanghai and the London Metals Exchange. Of course, that's after Chinese regulators clamped down on high-frequency trading. We can see Glencore, Rio Tinto, Antofagasta, BHP Group all down in the red this morning. Flipping over to a bit of M&A news, of course, that being Glockner, Worthington Steel agreed a takeover of Glockner, boosting those shares almost 30% off of the back of that news, saying that there's highly actionable synergies between the two companies. Next up, we've got ASML that was in the news yesterday as well, off of the back of that bullish guidance from TSMC. ASML being raised, Morgan Stanley raising the price target for ASML by 40%, saying that demand in China looks, quote, better than feared, up nearly 1% off the back of that news. Finally, we got Close Brothers, RBC upgrading Close Brothers to outperform, saying that the lender has, quote, more fat to trim. Those shares up 8.3% off of the back of that news.
Jennifer Gray, thank you very much indeed on some of the individual stocks on the move this Friday. Coming up with some of the top US banks results out this week, of course. We're going to be unpacking the key takeaways next. Maybe get a nod ahead as well to the European bank earnings story. This is Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Election, Canada's new government began to recalibrate our relationship with China. Strategically, pragmatically, and decisively. Peu après les élections, j'ai discuté avec le Premier ministre Li. 2 mois plus tard, nous nous sommes rencontrés à New York. En octobre, j'ai rencontré le président Xi en Corée du Sud. Avec un dialogue soutenu.
We almost had it. Carney was speaking in English and talking about the relationship between Canada and China. He's in Beijing. I'm not quite sure where he's in Beijing. Maybe Tom can update me. But then, yeah, switching to French. And we'll dip out of that.
We could have had Tom with the live translation. I'd have given it an effort, but yeah, maybe not best serving.
Yeah,
I'm not sure if that's
our audience.
I'm not sure if that's a forbidden city or not, but Look, it's important. Prime Minister Carney's there. We've had a number of leaders have been over in Beijing trying to cement or at least improve their trade ties with Beijing. We've got Prime Minister Keir Starmer's heading over there shortly as well. And Carney doing something of a reset. They're talking about, obviously, agriculture. They're talking about energy.
Supporting clean energy, which is
Supporting clean energy. I thought it was interesting from the Trade Minister, the Canadian Industry Minister, Melanie Joly, said yesterday, you know what, I'm quoting, you know what, the conversations have been more predictable and stable than sometimes with other countries, including our neighbour.
That's not a big surprise, though, is it? It's been quite volatile, the relationship with Washington.
Yes. Interesting in the context of the history of China-Canada relations. Right, we're going to switch focus now from Prime Minister Mark Carney on the ground in Beijing to global credit markets, which are running at their hottest in 2 decades, prompting some of the world's biggest money managers to warn against complacency. We're joined now by Bloomberg's Helen Durand for the details. Walk us through what's happening in the markets, where the complacency lies.
Everywhere, arguably, from high grade to high yield. You've had a flood of money pouring in for the last sort of 12 to 18 months, and it's basically investors have had to kind of deploy it, and it's basically.
How did we get here? A lot of issuance is how we.
A lot of issuance, but also a lot of money. Yields are high. They've been, it's kind of the best yields that people have seen for, years. So it's been sort of hard to ignore. And also the quality's gone up. So even in the junk market, where arguably normally, where the kind of bad companies are, because a lot of the terrible companies have gone to the private market, the quality's gone up. So actually it's gone up a lot safer. A combination of money and upping in quality, balance sheet is strong.
Spreads to govies, can they get any tighter from here?
It's a good question.
Are they really tight?
I think the view is probably will stay stable from here. If anything, maybe we'll go a bit wider. There is a lot more supply coming. Big tech, a lot of AI, capex that needs to be raised in, and a lot of it will come to the debt market.
But am I getting paid for the risk, I guess, is the question that I'm really asking.
I think a lot of people said you're not. But having said that, what else are you going to do with your money? Where are you going to put your money? There's very few alternatives out there.
And there's some big corporates that people note, can raise money cheaper than their governments.
Absolutely.
So we've talked about France. We've talked about a couple of big names on that front. They're still very much the outlier, though, aren't they? That's not. Or is it becoming increasingly a phenomenon?
I think for now it's still, it's still quite rare. But you do see it, as you say, countries like France, where it's been, the finances are in trouble, arguably. Same with the US, massive deficit, where you've got this sort of Alphabet and Microsoft of this world that are, trading sometimes tighter than the govies. So
this takes us to Jamie Dimon, though. He talks about cockroaches back end of last year. And at the moment, there have been a couple, but there haven't been that many.
So we might need to keep our eyes open for if there are more. Helen, well, thank you for that. Thanks for the update on the credit markets, Helen Durand. But with that thought about cockroaches and where they might lurk, where problems might come in the future for the banking sector, let's talk about the banking sector. Results from Morgan Stanley and Goldman Sachs wrap up a big week of earnings for Wall Street banks. Goldman Sachs blew through expectations for equities trading revenue, posting an all-time Wall Street record of $4.31 billion in the final 3 months of last year. During the analyst call, CEO David Solomon spoke about remaining dynamic on share buybacks.
While the bar for transformational M&A remains very high, we will continue to look for ways to accelerate growth in asset and wealth management. In addition, we have $32 billion of remaining buyback capacity under our current share repurchase authorization. And while we are mindful of our current stock price, we will remain dynamic in executing repurchases.
David Solomon there, of course. Let's bring in Bloomberg's Tom Metcalf. Tom, I feel really bad talking about cockroaches. Guy made me do it. But, this was a positive story coming out of the banking sector, wasn't it, yesterday? So maybe we should linger on that for a moment. What were your takeaways then? Let's do that. Morgan Stanley, Goldman Sachs.
Yeah, certainly from Morgan Stanley and Goldman Sachs, the biggest takeaway is just how strong Wall Street kind of narrowly defined, the capital markets side of the banking business is doing. So both of those results, really stellar shares, really jumped. And as we just heard, the CEO is very, very bullish, and that, you know, across the board strength, but particularly equities traders. And at Morgan Stanley as well, I think their debt underwriting almost doubled. So very, very strong performance. And then it's kind of, as you look back at the whole set of results with JP Morgan kicking them off on Tuesday, it's a bit more of a mixed picture, and moving away from Wall Street to Main Street, I think that's where maybe there's a little bit more kind of downside risk, bit more nervousness. But the basic message is these banks are making more money than ever, and it kind of depends on your outlook, how sort of positive the shareholders are reacting right now.
And Tom, I'm wondering whether the regulatory environment is positive for banks in the US or not, because you've got the focus on credit cards, but also talking, particularly when it comes to underwriting and M&A and deals, of a cut in regulation, and that being supportive. But the regulatory regime is kind of complicated.
Yeah, exactly. There's kind of, you know, Trump takes with one hand as much as he gives, right? So you have seen, because of the deregulation and general animal spirits, let's call it, coming back in, you know, huge boost in business. But then that's one of the big drags on, for example, JP Morgan, Trump coming out by social media saying, you've got to cap your interest rates on credit cards. And that would basically destroy...
Which is not law yet, but it is a proposal. No, and some senators are looking at, some lawmakers are looking at this.
Absolutely, a lot of pressure from across the political aisle, but I think the thing that the bankers were saying, and they were quite strong on this, is we see effectively no legal reason for this. We're going to push back as hard as we can. You know, very strong words, particularly in kind of a Trump era.
If Morgan Stanley and Goldman Sachs did very well, what's the quarter looking like for Barclays and Deutsche?
Yeah, so they'll be reporting kind of early February, really, and you know, with the big investment banking business and big investment banks, the question is, can they actually take any share from these, you know, Wall Street banks? Because that's what I would constitute as a great performance. And it's difficult. We have some analysts saying they expect they can, but then you look at some of these numbers and you're like, you know, Morgan Stanley did so well. They're presumably
did they take money away from JPM?
I think
JPM the loser this quarter.
It does, you know, it's slightly harsh to call them the loser, but yes, they disappointed, at least on the investment banking side. And, you know, their executives were quite clear on that. They said, look, part of that was some of the deals got pushed into 2026, but part of it was underperformance, and it's something they're looking at and not very happy about.
Tom, on European banks, what's the consolidation story for 2026?
Well, I enjoyed my 2025 with lots of sort of more middling deals, I suppose, and it's probably going to continue in terms of, I still don't see that sea change that's needed to do something, you know, seismic. So, you know, a UniCredit and Commerce Bank, for example, something that will really, I guess, frighten politicians. But a bit like the US, the animal spirits are there. Already this year we're seeing sort of deals pop up, and I just think it's just going to be a bit more, again, of lots of deals which, you know, maybe don't, you know, it's important on a domestic level or for the bank itself. You know, maybe there'll be some insurance deals and asset management kind of consolidation. But yeah, sadly for me, the kind of dream of, you know, Barclays behind a huge bank is probably unlikely.
Maybe they make money out of other people's M&A, though. That was a big theme in the
you can win on
US
both ends, right?
story. Yeah. So
bankers generally try and win on both ends. Tom, great stuff. Thank you very much. European banks trade on some pretty punchy numbers now. It used to be that you trade on a huge discounted book, and now that is gone. Anyway, AI could be one of the big factors in terms of bringing costs down at some of these banks. In the long term, near term, maybe having a slightly different effect. Anyway, a new report by Boston Consulting Group finds that companies are expected to accelerate investments in AI this year. Jessica Apotheker is going to be joining us, senior partner at Boston Consulting Group, BCG. Sorry, that's coming up next. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
This is the opening trade. Happy Friday. We are 30 minutes into today's session. A bit of lack of conviction, it seems, across the markets, at least at the benchmark level. European stock 600 currently down just 0.1%. Here in the UK, the FTSE 100 is off by around 0.2%. Basic Resources is something of a drag. It's the biggest loser across your sectors. The DAX over in Germany dropping 20 points, and over in France, the CAC current is off by 0.2%. Guy is breaking down the details for us. Guy.
Yeah, more stocks down than up in the stock 600, 340 versus 237. Volume's a little bit light. We're going into a long weekend in the United States. Just think about that in terms of your risk management as you work your way through towards the back end of this session. Let's talk about the leaders. Pharma's doing fairly well. I think there's some B of A upgrades floating around in the market this morning, and it's lifting Nova, and I think it's lifting Novartis as well. Siemens Energy is up. Is that the AI electricity trade story that we're watching in the United States? Because in theory, these companies, these AI companies, are going to force through the contracts the generating companies in the States to have to build more gas-fired stations and, you could argue, nuclear stations as well to provide the electrons that AI is going to need. Is that the trade this morning? I don't know, but it's up and it fits. Let's talk about where we're seeing some downside. There's a metals theme that runs through all of this. I kind of... Richemont had a great day yesterday, but it makes quite high-end watches that are made of gold, silver, platinum, etc. It's down by 3.2% this morning, but it did really well yesterday in terms of its numbers. Rio is down, Glencore is down. You are seeing a few wobbles in the commodity complex this morning, and you price them pretty quickly into the metals producers. So that's pretty much why we're seeing what we're seeing this morning. What else do we need to know? Anna.
Yeah, let's get an update on some of the other news flow. JP Morgan is looking to add deal makers in Europe. Executives at the bank expect 2026 to be one of the best years ever for mergers and acquisitions, boosted by lower interest rates, stable credit conditions, and a backlog of delayed transactions. Denmark and Greenland are stepping up lobbying of US lawmakers in an effort to head off President Trump's push to take control of Greenland. A group of US senators is set to meet members of the Danish Parliament in Copenhagen later today to discuss the issue and show support for Greenland's sovereignty. President Trump and governors of several U.S. northeastern states are, as Guy was suggesting, taking an unprecedented step to get tech giants to pay for surging energy prices. The administration plans to direct the country's largest grid operator to hold an emergency power auction today. The plan seeks to address growing tensions over how the nation can supply electricity to power-hungry data centers. Tom.
Okay, well, let's get a different element to that story, because TSMC says it will try to speed up the transfer of its advanced chip-making expertise to the US while continuing to develop and maintain its top fabrication techniques at home. TSMC's CFO told us that even with faster transfers, it would still take at least a year for mass foreign production of its leading technology.
we don't look at it this way. It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then.
Okay, TSMC's CFO speaking to Bloomberg's tech reporter Annabelle Drulers, and of course the run-up in terms of the gains that came through, in terms of the CapEx story for TSMC led to those additional upside and gains for tech more broadly, globally yesterday. And if you are building the picks and shovels and you're building out the data centers and you need the chips to go in them, then what's happening at the adoption level? Let's get some answers and bring in, at this point, Jessica Apotheker, senior partner at Boston Consulting Group, that has been analysing the uptake of some of these AI services at the other end of the spectrum. Jessica, we're talking there and hearing from the CFO of TSMC in terms of the infrastructure part of the AI story. What are you and the team seeing in terms of, at the enterprise level, how much appetite there is for adopting this tech and whether or not that can be sustained?
Well, I want to say that the customer demand that he was talking about is really on the rise and buzzing with optimism. When you see this year's report, so you see the intent of investment of corporates behind AI for next year. The intent of investment is 2 times more than what it was last year, which is just huge. And the other big novelty this year is that people are committed to AI no matter the short-term return. You see 90% of CEOs saying they are committed to continuing to invest behind AI, even if they're not hitting returns this year. So a lot of confidence and definitely appetite behind this technology.
How does that play out sector by sector? How much differentiation is there, for example, in financial services versus energy versus the consumer? Are you seeing that breakdown? Are you seeing differentiation in terms of the pace of adoption and the willingness to invest?
For sure, we see CEOs at the forefront of the AI adoption across every industry, every sector, and also, I want to say, every geography. So there are these CEOs that are at the forefront, but there are some in sectors that are more ahead than others. I'd say exactly as you said, technology, financial institutions, insurance, they're way ahead in terms of absolute level of investment already this year, planning to increase next year. But we do see some sectors catching up. For example, the consumer goods industry that was quite behind this year, actually they declare very high intent of investment for next year. So in general, across the board, optimism, more investment, some nuance there.
Jessica, you said a moment ago that these CEOs are investing with little regard for the short-term return. They're not worried about it. They feel they have to invest. You almost have to spend the money to answer the question as to whether or not AI is going to deliver. Would you describe this investment, therefore, as speculative?
Well, if you see the interpretation of why CEOs are doing that, it's much more because they have confidence in the long-term return of AI than anything else. When you ask CEOs, 60% of them believe that there is confidence in the return of AI on the mid and longer term. So no debate there, that they're in there for the strategic game. They actually believe in the technology. It's not such a defensive game. But there are nuances. Again, you'd see, for example, in the Greater East, much more optimism and much more investment behind growth. What you see more in the Western markets is more of a mixed picture, a lot of confidence up from last year, but also much more of a defensive play and not wanting to fall behind AI. So there's a little bit of both.
So what does that mean in terms of the longevity of this investment? When do they need answers? When does the question about efficiency and return need to be answered by?
Well, I think it is a positive cycle in a company, right? When you see what we see in the research is that when the CEO is confident, the CEO actually spends much more time in being personally prepared to be the chief AI officer of the corporation. We see CEOs leaning in personally, spending that time, and when they do that, they commit more capital behind the AI transformation. They also commit more capital behind training their workforce at scale, really landing that skill set in the organization. And when they do that, you see much higher returns, actually. You see returns, and especially on the growth side, not just on the productivity side. So it is not a question that the returns are not there. They are there, but they take the right momentum in the organization to unlock.
Yes, interesting in your research, Jessica, good morning, that you suggest that this is turning into something that CEOs lean into personally, not just CIOs and CTOs, which is interesting in itself. What do trailblazers look like in this space? What is it that meets that definition, I suppose? Is it to do with the amount of money deployed, or is it the way that they prepare their businesses, they train their workforce to make the most of this technology?
It is that pickup is also what I picked up in the survey this year, is that really the role of the CEO personally is the seismic shift that we see. We see 70% of CEOs saying that they behave as the AI officer of the company. Last year it was much higher on the CIO and tech side. Now, to that, what needs to happen? The first thing that is the unlock is the actual personal attitude of the CEO. It's the state of mind that cascades from the top down. What you see is when CEOs are positive, when they are confident, when they invest personal time, then that actually drives the entire organization behind them. So one number that really struck me was that the CEOs that are trailblazers that you're talking about, they spend 8 hours a week actually training on AI. That's a huge number. That's almost a full day. And then that cascades afterwards in much more capital invested, as you say, also investing behind technology that is more at the forefront, like agents. So it's that attitude that is the real unlock of trailblazers.
And Jessica, when you see Europe versus Asia, which seems to be leading from what your research tells us, Europe, broadly defined, so EU, UK, everything, seems to be behind. Is that a function of sectoral exposure, or is it something else?
Well, they're leading from a confidence standpoint. I don't know if they're leading from an outcome standpoint, but when you see, what is true is that in terms of confidence level, in our survey, we see CEOs in the Greater East declaring very, very high levels of confidence behind AI. And as I was saying, that attitude of CEOs is so important for the rest, that the key point here, I think, in Europe is with all of the macroeconomic context and some of the focus that we have, we need to shift that attitude of corporates more towards believing in revenue growth, believing in that AI long-term return, and then that is the momentum that we need.
Jessica, do you have a sense, given the decision-making and given the aspirations of these CEOs and CFOs on the spend around AI, well, who's going to benefit? Is it the legacy providers, the SAPs of the world? Is it the Salesforces of the world? Or is it the Anthropics with their enterprise proposition? Or is it some of the incumbents, the Pigments of the world, offering those new software solutions that are empowered by AI? Where is most of this money going?
Well, like for every new technology, there's a full ecosystem that goes behind it, and nobody has a crystal ball on who will win in that ecosystem or not. What you see, if you make the parallel with the internet technology or the digital technologies, there were both new entrants and incumbents that won. What really matters is the way you engage on the transformation and how deliberate you are on that shift. I'd say from a customer standpoint, from an enterprise standpoint, CEOs are looking for end-to-end solutions that help them break silos between actually technology, data, AI, and that training of the workforce that they need to get to the results. If it's just technology off the shelf, it's just not enough for them to getting the return. So they're waiting for the ecosystem to support them on all of these needs.
Jessica, really useful. Thank you very much indeed. Jessica Apotheker, Senior Partner at Boston Consulting Group. Thank you very much indeed. I'm sure AI will certainly be a feature of the landscape next week when it comes to those attending Davos. Donald Trump will be there at the World Economic Forum. How should executives handle an encounter with the US president in Switzerland? Now, a bit of advice next. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
We are concerned about that. We think it's probably just too early for that story.
I'm more worried about an overheating US economy than one that goes into recession this year. One thing I'm really struck by is this quarter alone, we have the biggest fiscal impulse of any quarter since the Biden stimulus. And that was in a recessionary context with unemployment at 6 or 7%.
What we're seeing is a stabilization in the labor market rather than a reacceleration.
It seems like, you have to start imagining the unimaginable.
Highlights from a few of our guests this week talking about the risk of, well, what are the risks for the US economy? Is it about a slowdown, or is it, as we were talking about there, about an overheating? And we have had various views on that subject, but overheating and risks around inflation certainly coming back into the narrative this week.
Back end of last year was American economy slowing down. The labour market's the big focus. We have moved away from that, it seems. And look at the claims data yesterday, really positive.
Yeah.
You look at what the Fed story is definitely there. But the sense seems to be that Trump wants this economy to reaccelerate, certainly into the summer, so that he's got a chance into the midterms. And it feels like it's politically...
We've had two opposing views on inflation this morning, from Chris Watling, who thinks inflation is going to come down lower, and then Patrick from Plurimi, who thinks that inflation, if not this year, then certainly in 2027, has become a real problem because of lower rates, fiscal impulse, regulatory cuts. It's all going to come to the bear.
When does the US 10-year break out on this? You look at Skylar to try and find answers.
She's got the answer.
Skylar's here.
Yes. I mean, I think that's exactly what the Fed is also struggling with, right? We've got all this uncertainty over where the economy is headed. At the same time, you likely have a more divided Fed because you have dovish outliers. You're going to have a Fed chair that probably doesn't represent the consensus and is more likely to have dissents within the committee as a result of that. And you don't really know where neutral is, or, as you get closer to neutral, you get more dissent with the Fed naturally. And so I think that means that rates volatility has to rise at some point because you're watching for data and Fed speeches much more.
Is the focus now fully on inflation versus jobs? Is the labour market concern out of the picture now?
I don't think necessarily completely out of the picture because you have these dovish outliers. They're kind of like bringing that dot down across the curve. And people want a kind of softer labor market because it's good for the equity market because then you get some more dovish impulse as a result. So I don't think it's completely out of the picture, and it's something that's definitely being focused on.
It's just crazy, isn't it? That's basically, that's the narrative. And it's basically that the Fed is the Fed supporting the American people and kind of, is that its objective, or is it basically just to keep financial assets elevated? And I think we all know the answer to that question.
Well, yeah, and also how connected are those two things? As in,
yeah, that's true.
Are we now more dependent on the asset markets running hot to have a strong economy? I would argue it's maybe not as stretched as some people think. There's evidence that we're not as K-shaped maybe, but it's certainly something to be mindful of, especially when it comes to the U.S., because the average person is much more thoughtful or watching headlines around equity markets, et cetera, so it does impact confidence.
Well, the U.S. might not be as K-shaped as maybe we thought, but President Trump is certainly focused on the bottom part of that K, isn't he? And there's something that doesn't really add up in 2026. You want to run the economy hot, but you don't want inflation that hurts the bottom of the K, so then you're taking all these other policy actions to try and really minute detail limit inflation. I suppose the question is whether he's successful in doing that and then can get his rate cuts.
I think that's quite hard on the inflation side, because if you have strong demand, when you have tariffs being imposed, that's a price level adjustment, and it feeds into the economy more sustainably when you have consumption that's stronger. And so I think that's a very hard thing to think about. What's more interesting maybe is the rotation you're now seeing within the equity market, where small caps are suddenly popular because there's this idea that growth in the U.S. will be quite strong. You're getting support of that lower kind of bucket. And we're thinking about the tax bill that, it happened last year, but now we're only thinking about it.
Is that just a US story, that small caps, mid caps rotation? I was looking at the MDAX yesterday, some analysis on Markets Live suggesting that the MDAX has not priced in the fiscal push that we're getting in Germany, and that maybe actually there's room in Europe for that kind of story. Is that something we see?
I mean, maybe more so in the equity market than other markets, in terms of you did have a big yield move and a big euro move on the announcement of fiscal, and I think we're actually likely to have disappointment relative to what was announced last year, in terms of there was this expectation you'd get broad spending, not only from Germany, but the other countries. And because these other countries have bigger fiscal concerns, that spending hasn't actually come through. And German spending in itself isn't as stimulatory as originally expected, as in half of it's just going towards day-to-day operations. So we priced in quite a lot relative to the U.S. in particular. I think it's likely to disappoint.
I'm assuming that you're going to spend your weekend just watching the yen. That's the story this weekend, isn't it?
She looks surprised when you suggest that.
I do have a life. Skylar does have a life.
Yeah. You are allowed a life. You don't have to be on the intervention watch for the whole weekend.
I think it's definitely something we need to be looking at very closely right now, because we are at key levels, because intervention is, they do take opportunities in markets where they can get bigger moves. Because the issue with unilateral intervention is that you can't get sustained upside in the yen as a result of it. You're just kind of presenting a ceiling because you don't have unlimited amounts of yen.
Jane Foley was suggesting for Rabobank that maybe that the Japanese get some help from Scott Bessent, that you get joint intervention.
That would be a game changer in terms of when you do have combined efforts to strengthen a currency, it can be quite significant. Because if you look at the last rounds of intervention, the only one that really worked was the one that you had U.S. inflation data come in and change the story on the dollar side. So if you have something coming from the U.S., you could see a significant amount of move.
Okay, you've just made Guy Johnson's weekend that much more exciting, Skylar, because that's where his focus is going to be all weekend. Skylar, thank you very much indeed. Bloomberg Markets Live. Skylar Montgomery and Koenig, of course. Let's get another view on this, and particularly how US corporate leaders are going to be adjusting to Trump policy, and that kind of ties in to the FX space as well. US President Donald Trump, of course, will be leading one of the largest ever US delegations at the World Economic Forum's Davos event, of course, next week. All kicks off. Business leaders will be, of course, wrangling with the US president, who has one eye on the midterms, as we've been discussing, and those squeezed consumers at the bottom end of that K, of course. Bloomberg's Francine Lacqua, who is no stranger to Davos, will be in Davos next week, of course, joins us around the desk right now. It's going to be quite the spectacle then, Francie. These CEOs are going to have to both call and adjust to President Trump, who's becoming kind of much more interventionist, it seems.
Yeah, so I think the first question, and good morning everyone, is trying to understand what kind of President Trump will get in Davos. So remember, this is his third in-person intervention in Davos, first time 2018, where he said, look, American first does not mean America alone. So this was someone that was a lot more open to bilateral trade deals, and helping the world. Then comes 2020, he was much more defiant because he was right at the start of his impeachment trial. And then last year, it was a couple of days after inauguration, it was down the line, and he really focused on oil and oil prices instead of geopolitics. So what do you get this year? You get someone who wants to be involved in foreign policy. You have someone that really goes after CEOs. And so CEOs will want to be close, but not too close. There are chatters of saying, well, if you see the president, do you say, hello, Mr. President, or do you try and wait for an invite? Look, in 2018, he charmed everyone. A lot of chief executives, especially the European ones, didn't necessarily want to go to a reception perception that he was holding for them. And then the next day, one by one, they were like, he's really charming, and especially one-on-one, he gives you a lot of attention. So, it's going to be an interesting one.
And I suppose how they deal with him in the moment when they get that time, whether that's one-on-one FaceTime or just in passing. We had a great story yesterday that was suggesting what you need to do to charm the president is you go on Fox News and you bring some kind of gift. I don't know if those will be being exchanged in the halls of Davos, but this must be on their minds, what they do with their sort of elevator pitch moment with President Trump.
Yeah, so I hear from a lot of European CEOs, the ones that have been, you know, a lot of the French ones have operations in the U.S. and sometimes feel like they're not given credit enough about how much they're doing in the U.S. or even changing some of the supply chain. So I'm sure if you have your, 30 seconds elevator pitch with Donald Trump, you say, I'm the CEO for that, I invest that much in your country, hoping that then you don't, get taken aim to. Look, I think what happened with the Exxon CEO was really interesting. Because of what's happening in Venezuela. But then a lot of insiders say, they don't want to be in Venezuela. So actually, if he freezes them out, it's maybe better for shareholders.
So last time it was the bank CEOs, wasn't it? In the front row. And he was just like, you're causing me trouble. So, yeah, that speech is going to be...
Caroline Levitt yesterday said he will be out giving out, this is quite minutiae, but we're dealing with that now. He'll be outlining housing initiatives at Davos. So I wonder if that'll be an area where markets could move, because he makes policy announcements and markets do move.
There's a Davos, we've got Trump House.
We have a USA house.
Those houses.
Yeah.
Which is outside the Congress Center, so it's out the security zone. I mean, I'm told they have a lot of security and a lot of Navy SEALs that have been hired extra to try and keep that delegation safe. But they basically have back-to-back programming, so we could have a big speech from there from either him or one of the people in the cabinet.
Fran, who beyond President Trump are you most excited to speak to?
Don't make her pick one. They might all be watching.
I mean, what is give us some names.
I think, look, it's really trying to understand how people are anxious. I think it's the geopolitics. You hear, when you speak to a lot of the oil major companies, they're looking for Iran. We don't know what happens in the next couple of days. And so I think everyone's going to be on tenterhooks to just try and figure out what the next step is, which frankly is unclear for so many. And traffic. No one likes traffic in Davos. And my big prediction is going to be the worst year ever for traffic.
So is everyone going to be late to everything?
Delegation, probably.
Okay,
and a lot of walking.
That makes your life difficult.
Good boots.
Makes our life difficult.
Yeah. We've got an amazing week lined up.
We have.
We're just going to sit and watch.
Yeah.
Francine's going to be doing all the hard work. You're doing all the hard work. We're going to sit and watch some of the amazing guests and interviews that you're going to be doing as we work our way through the Davos program. It's coming up next week. Have a great weekend, everybody. This is Bloomberg.
This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Ahmed, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The record-breaking stock rally gains fresh momentum as earnings from the chipmaker TSMC revive confidence in the AI boom. Wall Street's biggest bank records their best-ever quarter for trading revenues and say the best is yet to come. Plus, a Venezuelan opposition leader gives her Nobel Peace Prize medal to President Trump as she seeks a role in the future of running her country. So happy Friday, everyone. It's been a very long week, as it has since the start of the year. Stocks actually rising to a fresh, burst, as there's been a bit of momentum being built by technology stocks. Now, small caps are on the up. We had a rebound in technology stocks following results from TSMC, which seems to have rekindled optimism around artificial intelligence, and the U.S.'s economy's resilience is expected to support a wide range of stocks. S&P futures getting some 0.3%. The other story is, of course, what's going on with yen as we look to Japan. This is a picture for European markets. Again, the focus very much will be on, I imagine, earnings, but also what will happen in Davos over the next week. And we're seeing a little bit of pressure on the CAC 40, the FTSE, and the DAX over in Germany. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the record-breaking stock rally is gaining fresh momentum after we had earnings from TSMC, which helps quash concern about overheating in the tech sector. There could be headwinds on the horizon as President Trump then seeks to make big tech pay for the surging costs of powering energy-hungry data centers. Well, joining us now is Matt Bloxham, technology analyst at Bloomberg Intelligence, and in a moment we'll speak to Alex Brazier of BlackRock. So, Matt, good news, no bubble for now.
Well, yeah, I think the jury's still out on the bubble question, but I think certainly the market's clearly breathed a sigh of relief after the news from TSMC yesterday, particularly that CapEx is going to be up kind of 15 to 20% year over year, increasing by maybe kind of as much as $10–12 billion on the back of a strong forward pipeline from TSMC's big customers like NVIDIA and Apple. So I think it's clear that the big hyperscalers are going to continue to invest big numbers in building out infrastructure in 2026. I think the big question still, though, is what is the natural demand, particularly from the enterprise market, to support all those investments over the midterm. We won't see the answer to that question until earliest the second half of this year, probably into 27 and beyond, because a lot of corporates are still kind of moving from that kind of pilot phase into the big critical question: do we double down on the investments? Is AI making enough of an impact in terms of extra productivity or additional market opportunities to justify the big incremental investments that these massive capacity investments are there to support?
Okay. And Matt, what are the practicalities, I guess, and the implications of President Trump saying that he wants tech companies to pay for electricity costs?
Yeah, so there's an interesting development. So I think we're going to hear news today of a suggested auction, particularly kind of in the kind of Northwest Atlantic area. Now, Virginia is in that, and Virginia is the single biggest market for data centers in the world, and there's a massive capacity squeeze there. Electric prices have been going up. Clearly, there are midterms coming up. President Trump and the administration want to see the economy looking healthy. So I think the fact they're looking at mechanisms to carve out the power that data center companies need so that it has less direct impact onto the consumer market is kind of an interesting move. We'll have to see today the details of what they're planning, but it looks like there's going to be an auction that compels data center operators to buy electricity on a forward 15-year view, whether they use that electricity or not. So it gives the kind of power supply companies some visibility about how they're going to deliver capacity into the market.
Matt, Taiwan is also downplaying concerns that its tech industry is being hollowed out by U.S. trade deal. The chief financial officer of TSMC tells Bloomberg the company will keep its best technology at home, but is aiming to expand in the U.S. Here he is.
We don't look at it this way. It really depends on customer demand. In the U.S., a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then.
So Matt, President Trump wants, of course, the best to be made in the U.S., but not so simple.
No, it isn't. The supply chain resilience theme is going to continue for quite some time, and obviously TSMC is also investing in Europe. What we heard there is absolutely true that there's years and years and years, and if not decades, of expertise and infrastructure in Taiwan to support the kind of leading edge semiconductor development. You can't just flip a switch and replicate both the infrastructure and the human capital expertise that goes into kind of delivering that stuff. So I think it's definitely not going to be months. It's going to continue to be years to kind of replicate this. And in some ways, there's parallels here with what Apple's doing. Apple's obviously looking to kind of take capability out of China, put it into India. That's been a multi-year process for them to kind of deliver on that. So I think, again, for TSMC, as much pressure as the Trump administration puts on them, there's always going to be a leading expertise in Taiwan, and it's a question of how quickly they can replicate that in the US. But it's not months, it's years.
Matt, thank you so much. Matt Bloxham, they're a tech analyst at Bloomberg Intelligence. Now, to dive deeper into the markets, with us now Alex Brazier, Global Head of Investment and Portfolio Solutions at BlackRock. Alex, great to speak to you. When you look at AI, I know you've gone from kind of liking investing in AI to also around AI. What does that look like?
Well, one of the big debates has, of course, been, is AI in a bubble? We really don't think so. We think valuations look high, but they actually are driven by fundamentals, and many of the core companies at the core of the AI theme have every opportunity to, if you like, grow out of those valuations. Now, the market's becoming, though, more discerning within the core of the AI theme, so we actually think it's worth spending active security selection budget on that part of the market. But also the AI theme's broadening out. We've just talked about power demand coming from it. We've seen great interest from many investors into clean energy, sustainable energy, energy of any sort, which is going to be needed to power the AI revolution. And that's where one of the bottlenecks is. Plus, as Matt was talking, at some point, this will become adopted more broadly in the wider economy. That will help to support the surge in productivity that we're seeing. It's helping to deliver a broadening of earnings growth into the broader U.S. economy. And so we've been tactically overweight U.S. equities for quite some time as the market broadens out as it's doing at the moment.
But at the same time, Alex, I mean, how can you tell when there's going to be a bubble? Because valuations just keep on rising, and every time we have constructive news from TSMC or NVIDIA, everything's fine. But at some point, it's got to match what you're spending.
I would push back on valuations keep rising. Actually, valuations for the mega caps have fallen earnings growth has been so strong that actually we ended 2025 valuations slightly lower. So again, it's not really a bubble, it's sort of fundamentals driven. Now the question is, will the hyperscalers in the long run be the ones who actually earn the most from all of this, or will the benefits be more diffused across the economy? And that actually leads to opportunities, we think, beyond what's worked well so far. So we're thinking about the sectors in the US economy that have the opportunity to adopt AI and deliver productivity improvements. But, you know, lots of investors are nervous about volatility at these valuations. And when we survey investors across Europe, they're pretty polarized. When we say, do you want to add to US exposure or subtract from US exposure? They say yes. But they're pretty evenly split between both of those options. And for the camp that's looking to reduce US exposure, they are worried about the high level of valuations, not because it's a bubble, but because they rest on some optimistic assumptions. And so they're looking, for example, at buffering their US exposure, giving up some upside to cap the downside. They're looking at tactical opportunities type strategies that are going to be pretty nimble through the course of the year to deal with that volatility. So there's a range of approaches people are taking in this
Alex,
environment.
how do you deal with shocks? So what we've been taught since January 4th of this year is actually nothing certain right now. So we're expecting maybe strikes on Iran, although the president has walked it back. Unclear what he does with a lot of the oil companies in Venezuela, and you don't really know what happens in Greenland, so what happens next? So how do you plan for this world which anything could happen at any moment?
I would say three things are going on. This is what's exactly on many investors' minds. The first is that people are looking in Europe to diversify geographically, to look to European exposures, Japanese exposures, and continued exposure to emerging markets. That's one. The second is investors are more and more alert to the need to be nimble through the course of the year. You know, our tactical opportunities strategies, looking back at previous years, have typically added about 5 percentage points of return through the year from moving from where they were at the beginning of the year. And so to your point, that's exactly the environment we're in. We need to be more tactical and nimble. But the third thing I would say is, in addition to buffering strategies, people are looking to take down broad market beta exposure in portfolios. When you're less certain about the direction of the broad market, actually it makes sense to look in portfolios for more relative value opportunities, more alpha, if you like. And so one of the key trends we've seen in portfolios over the last 12, 18 months is the introduction of more and more liquid alternative and hedge fund type strategies in portfolios to deal with the uncertainty you described.
What do you see going on in China? So are we importing deflation from China? And actually, again, a lot of this foreign policy coming from the U.S. is not directed against China, but they're the net losers in this. Do they retaliate?
Yeah, I think in Europe, the particular challenge now is that a lot of Chinese goods have, of course, pivoted away from the US and are coming now into Europe. So European manufacturing, we've seen under a lot of pressure from increased competition, well known around the automotive sector, particularly from China. Now, that probably will lead to a policy response at some stage, but it's also part of a sort of structural change we're seeing going on in the European economy, away from, if you like, traditional manufacturing and exporting to Asia towards defense and more domestically focused companies. So we see opportunities in Europe continued in defense and in broader value sectors.
What makes you worry the most about markets? I mean, you're fairly sanguine or fairly optimistic. Is there something that doesn't feel right now?
I don't know about not feel right, but I think when you look at valuations, they make total sense in the context of the productivity surge we've seen going on in the United States over the last 3 or 4 quarters. That actually has made many of the worries people had, you're old enough to remember last April, many of the worries people had then actually go away. Because with a productivity surge, the fiscal position makes sense, interest rates can come down, growth can be strong.
But inflation could come back.
But if some of that productivity actually proves to be a bit more transitory than people are currently expecting, then we're in a scenario where the Fed either can't cut rates like markets are expecting, or it does cut rates into a more inflationary environment, which is not great for the long end, not great for the dollar. So more generally, this is an environment where if some of the risks do materialize, it's not a kind of environment where stocks and bonds are moving in a nice opposite direction. So again, for portfolios, it means looking at buffering type strategies to take down volatility. It means looking at hedge funds and liquid alternatives. But it also means in this volatile environment, people are looking for more steady income in the portfolio. They're looking less at growth and high risk-taking, more income generation in the portfolio, which is why people have broadened out to lots more emerging market local currency debt, to securitized assets, and to more sort of unconstrained income generation strategies.
Alex, what's your take on the UK? So we've had a number of high-profile, also conservative Tory, MPs actually moving to reform. I don't know whether that changes the policy and complicates things even further for this Labour government.
I think the big issue at the moment in the UK, we've seen a string of news this week, actually, not to do with the politics, but to do with the economics. And the two issues that we're monitoring are, one, that growth, although it surprised a bit on the upside in the monthly number, still pretty anemic.
Yeah.
We're running at an annual rate of kind of 0.5%. There's nothing to really write home about. And that's an environment where the labour market continues to loosen. Second thing we've seen is that some of the inflation indicators continue to come off. So these sort of Indeed wage measure coming down, city inflation expectations coming down. And that's an environment where rates can continue to come down. And when you look at the market pricing of the Bank of England versus, say, the Fed, they're priced to be moving pretty much in lockstep. And yet one economy has anemic growth, no productivity surge, and wage growth coming down. The United States has a productivity surge going on, strong growth. So it seems to us that that relative play between the UK and the US offers an interesting opportunity in that context.
But do you worry that this government is not bold enough? So actually you're not going to see that kind of growth, and in 12 months the UK market will be less attractive than other places?
Well, one area where the government is being bold is around fiscal consolidation. I think it's underestimated, actually, quite how much consolidation is actually going on right now and that we're in the middle of. You see lots of talk about back-end loading, but it's going on. Yeah. It's going on right now. And the market started to give the government some credit for that. And as yields come down, I think some of that pressure on the fiscal position will ease a bit. Yeah. But growth looks pretty weak. UK equities have done reasonably well, but it's been very narrow. It's been very narrow in financials and aerospace and defence. We'd prefer broader European defence, some of the European value sectors and emerging markets.
So interesting. Alex, thank you so much for joining us.
Thanks
Alex Bacher, they're Global Head of Investment and Portfolio Solutions at BlackRock. Coming up, the JP Morgan Chief Executive rules out ever becoming Fed Chair, but there's one top job Jamie Dimon would consider. Or would he? Find out next. This is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Jamie Dimon, the JP Morgan chief executive, has ruled out ever becoming chair of the Federal Reserve, but he said he would consider the role of Treasury Secretary. Well, Dimon spoke with Bloomberg host and Carlyle co-founder and co-chairman David Rubenstein.
chairman of the Fed, I'd put in the absolutely, positively, no chance, no way, no how for any reason.
Okay.
Secretary of Treasury, I would consider, if a president calls you up and asks you to do something, you should consider it. So I would take the call and consider it and think about why and what they want, et cetera.
Well, you can watch more of that interview on the David Rubenstein Show, peer-to-peer conversation up next week. Now, Wall Street's 5 biggest banks reported a record-breaking $134 billion in trading revenue last year. The chief executives say that's just the start. Here's Morgan Stanley's Ted Pick.
We are well served to watch for any overreaching against ongoing global uncertainties and higher asset prices. 2025 results, and in fact, the results for every quarter over the last 8 are a blueprint for Morgan Stanley's success. We expect this mix of tailwinds and headwinds to prevail in 2026 and are prepared to continue to execute.
Well, with us now, Paul Davies, Bloomberg opinion columnist, and Tom Metcalf, managing editor for EMEA Finance. Thank you both for joining us for a good banking panel. Paul, what did you see, or what did we learn actually from Wall Street?
Well, as we just heard, record revenues. It was an incredible year last year, lots of volatility. I mean, I think equities did particularly well, and I think that's a really fascinating story in part because we've also been tracking the kind of the threat, supposedly, from the electronic market makers, the Jane Streets and the Citadel Securities and that sort of thing. And I think one of the things it shows is just how different a lot of these businesses are, traditional Wall Street versus the new guys, and they both get to make money at the same time. One of the most important things I think about the equities business in particular is that the banks are earning a lot more like asset managers in the sense that their revenues are very geared to the valuation of the stock markets through the lending that they increasingly do to sort of very large hedge funds through prime brokerage business, and also a lot of the derivatives activity, which is now, involved a lot more in things like quantitative investment strategies, designing sort of cheap fund-like products for their clients, which again are very geared to markets.
Yeah, and I mean, you can see the trading record is, some say, look, it's just starting. Certainly the bank CEOs would hope so, and they're saying it quite openly. Goldman also raising some $16 billion in this massive Wall Street bank bond sale. Where was the weakness?
Yeah, I mean, that's kind of interesting thing to pick out. It's probably less on the Wall Street side, sort of the capital markets, but much more on, the retail bank side, where you do have that sort of, very big risk of, what will Trump do next? So dominating JP Morgan's results, Citibank of America, was this concept of, a credit card cap on interest rates, which they were very clear on would really hurt those businesses. But, broadly speaking, these banks are making more money than ever. And so how the investors react now, obviously a massive run-up in shares already, is really where those risks are. And actually, I was reading Paul's column on the equities trading. It's really interesting. They're saying ideal setup, but I think, Paul, you're saying 2026 still looks good, but after that, can this really, this won't continue forever?
Yeah, of course. I mean, as I was saying, it's about valuations. We know that markets are very exuberant, both credit markets and stock markets. There's lots of stuff still coming to support sort of further growth in the economy and market performance in terms of some of the tax breaks and the one big beautiful bill, in terms of private equity activity. There's still kind of a wave of IPOs that people are expecting, but then that's set off against all of the uncertainties of Trump's policy making, of geopolitical risks, of potentially more inflation coming through, especially if we get a Fed chair who, wants to lower rates to please the president rather than manage the economy. But
were you surprised? So my head's in Davos mode, and of course we're expecting the president to show up, possibly, try and talk about the affordability crisis in Davos, which seems strange. So it's unclear whether he rounds up the private equity, titans, or the bank chief executives and kind of gives them a lecture. But it was interesting to see that JP Morgan and Citi don't feel this affordability crisis. This is your column from yesterday or 2 days ago in their numbers.
Yeah, and I think that's partly because they just don't really serve the poorest sort of 10-20% of the population, because those with like very low credit scores just don't get access to credit at the very large banks. They avoid them. So in some senses they don't feel it. But also, I think there's a large swathe of the US consumer for whom sticker shock, the experience of seeing things costing a lot more than they used to, still resonates, while actually they can afford to do some of the things that they really want to do. And a lot of the spending on cards that the banks were reporting, we had like retail sales numbers this week as well for November, and its car sales are growing very strongly. It's kind of the holiday spending on nice things is still going well. So it's it's a bit of a puzzle.
What can you tell us on IPOs or deal making in general?
Well, I think IPOs is one area where there is potentially upside, right? Even in the US, but sitting from my seat in Europe, like there's just been really.
Well, people are hoping.
They're hoping, yeah. And that's the funny thing is, you talk to the bankers as you'd expect. They talk a great game, right? Like it's all about 2026. So we have a good story today about JP Morgan planning to hire across Europe because they are seeing or talking to investors and going, no, there's good sentiment out there. And of course, for me, the interest there is you've got these massive US banks doing very well. On a different scale to even the largest European banks, to be frank. And that's a big worry, just from a competitive point of view, because if a JP Morgan decides, look, we really want to get in there even more than they are, they've got the resources to basically do what they want. And that's probably what's keeping up European executives.
So what this would be them actually getting the IPOs, or also is there a worry that they scout the best talent from European banks because they can afford to pay them more?
Yeah, well, they just see more of a pipeline, so let's see if that comes to pass. JP Morgan was the one Wall Street bank where the deal making actually disappointed in the fourth quarter. But they're saying, look, there's enough demand here for us to effectively expand our footprint. And, if you're an ambitious banker, the Wall Street cachet, definitely largely probably rather work for them, and they can certainly pay the most.
Yeah, JP Morgan, had a bit of a wobble. We're so used to them beating everything and everyone that actually this time around it could have been better.
Yeah, no, it was very surprising. On the day it didn't seem that bad, but after everybody else had reported, it was really noticeable that in deal advisory and in debt capital markets in particular, they really missed a trick in the fourth quarter. Their revenues shrank compared to the fourth quarter last year, while Goldman and Morgan Stanley were both up like sort of 40-something% in deal advisory. Citigroup was up like 80% in deal advisory. That's probably because they had a particularly poor quarter in the year before. But yeah, it's very surprising. And now at the time, Jeremy Barnum on various calls was saying some of this is just about timing. Things got pushed into the first quarter of this year, which, can make sense. But he also said there are things that we need to look at, and maybe some of this hiring is part of that.
Yeah, do we know why they weren't as good as some of their competitors?
No, and that's the thing to find out, because like you say, JP Morgan normally, a banner bank on the deal making, and it's all coming from very, very high bases, right? So you have that context. But yeah, I was a bit like Paul. Yeah, kind of as the week went on, you went, oh right, this is something even more worse than it looked like at the time.
Okay, well, hopefully we'll get to speak to some of the executives also in the next couple of weeks at JP Morgan. Thank you both for joining us. Tom Metcalf, Managing Editor for EMEA Finance, and Paul Davies, Bloomberg opinion columnist. Now, coming up, President Trump has repeatedly said he deserves the Nobel Peace Prize, and now he has one, despite never winning the award. That story's next, and this is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time we went to Peru, trying to culture food. I never had this ingredients never used in Japan. Kind of like a wow, and cilantros, chili, garlic, and olive oils. So a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi, but Peru use fresh fish, make the called ceviche, cooked with lemon juice. Never use soy sauce. First time I eat this, kind of wow. So then after this one, my open eye more, my cooking style that change, combine to Japanese style and another country food, then make novel style.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. A record-breaking stock rally gains fresh momentum as earnings from the chip maker TSMC revive confidence in the AI boom. While Wall Street's biggest banks record their best-ever quarter for trading revenues and say the best is yet to come. Plus, the Venezuelan opposition leader gives her Nobel Peace Prize medal to President Trump as she seeks a role in the future of running her country. Now, Denmark and Greenland are seeking congressional support from U.S. lawmakers to push back on President Donald Trump's desire to take control of Greenland. A group of U.S. senators is set to meet members of the Danish parliament in Copenhagen today, including Jean Shaheen, the most senior Democrat on the Senate Foreign Relations Committee. Well, she told Bloomberg that the White House should focus on diplomacy.
I don't think there is any concern on the part of our allies, Denmark and Greenland, about partnering with the United States. And that's the route we should be taking. It should be diplomatic. We should be engaging in conversations if there is an interest on the part of this administration in additional operations there.
And you can listen to that full interview on the Michelle Hussein Show out later today. Now let's get more from Sarah Strolin, Bloomberg's Copenhagen bureau chief. Sarah, thank you for joining us. After a week of really frenzied diplomacy, what has shifted?
I think the temperature has probably taken a notch down. It's been very high tension in Copenhagen, Nuuk, and probably also Washington this week. But after the meeting between the Greenlandic and the Danish foreign minister and Rubio and Vance on Wednesday, where things did not escalate, there was some concern here in Copenhagen that things would explode after that, and it hasn't. So I think we moved the discussion from the public, from the media, from social media into more diplomatic circles, and that seems to be a win for the Danish officials.
So what's Denmark's strategy going forward?
It's definitely to try and pursue a more measured discussion in this working group that they set up. They're supposed to meet within the next few weeks and then every 2 or 3 weeks following that. There's still some debate between Copenhagen and Washington what this working group is set out to achieve. Is it still for the U.S. to take over Greenland, or is it to try and find a diplomatic solution where maybe Denmark agrees to more military, NATO steps up its presence? But I think for now, Denmark is just really happy that there seems to be a path forward where they can talk in a more closed room with other diplomats.
Sarah, thanks so much. Sarah Strolin there, Bloomberg's Copenhagen bureau chief. Now, earlier this month, President Trump dismissed the Venezuelan opposition leader, Maria Corina Machado, saying she had no support or respect. But in a meeting at the White House yesterday, President Trump praised her after Machado gave him her Nobel Peace Prize, something Trump has frequently said he deserves. Now, let's discuss U.S. policy in the country and wider geopolitics with Laurel Rapp. She was previously at the U.S. Department of State been White House National Security Counsel and is now director of the U.S. and North America program at Chatham House. Laura, thank you so much for joining us. I know it's been extremely busy, so we're extremely grateful that you're giving us a little bit of your time. What happens in Venezuela is at the moment quite complicated to understand the way forward, whether we are going to see some stability. But is it really the blueprint of what we could see in other countries, or is Venezuela different?
We're seeing in this new year a very aggressive foreign policy move across 3 continents, in Latin America, in the Middle East, and in Greenland, in Europe as well. And so we're seeing a president who feels unrestrained, who feels quite emboldened from his U.S. military action in Venezuela, that by all measures, if you are seeking to remove this leader from Venezuela, was a success. It did not collapse the economy. It did not collapse the security structure of that country. And so presumably in his view, he sees that as a potential success and a model to emulate elsewhere.
Are there any limits to what the Trump administration thinks it can do in matters of foreign policy? Like, I mean, what happens with Greenland if you're a European is quite shocking at the moment. Even seeing some of the NATO helicopters having to land a couple of days ago to make sure that they defend it. But it's unclear what the Trump administration would actually do.
We're not really seeing those meaningful constraints we've seen in past foreign policy decision-making processes. The U.S. Congress has not been able to pass legislation to constrain the president in the War Powers Act. The U.S. public opinion, although it is broadly opposed to the foreign policy actions the president is taking, it hasn't yet really come push to shove as the midterms approach 9 months from now. And in terms of the partner responses, fairly muted response globally on Venezuela. We're seeing a different, potentially more forceful response on Greenland, particularly from NATO allies, in which the U.S. has a mutual security treaty. Remains to be seen how the U.S. and Europe seek to move beyond this very heated, very norms-breaking impasse. We're at an impasse right now.
What would deter, actually, the U.S. to move aggressively in Greenland? And again, I don't know whether it's force or whether it's friendliness, like we saw with the Venezuelan opposition leader and the Nobel Peace Prize at the White House yesterday.
Look, Europeans are in a tough spot right now. I think there are 2 paths. One is the path of offering an off-ramp, providing some assurances that security will be bolstered in the Arctic, in Greenland. And we're already seeing European member states send additional troops. This is the purported reason for why President Trump wants to take Greenland. He says Russia and China is threatening its security, threatening our access to the Arctic. So the Europeans have called in President Trump's bluff and said, we're going to put up more troops to deter against this meddling in our region. So far, according to the White House press secretary yesterday, she said the president remains very interested in owning Greenland, and additional European troops will be insufficient.
Laurel, does this go back to the midterm, that actually there was a bit of a wobble, it felt like, in the Trump administration because the polls were so bad, and suddenly the focus is on affordability and actually critical everything, minerals, critical oil, to make sure that people get a better living standard in the U.S.?
That's right. The main issue that elected President Trump in the first place, and the main issue animating voters right now in the United States, is affordability, is on economic issues. And one thing we're seeing is President Trump has not really been making a very strong case to the American people about why Venezuela, why Greenland, why Iran connect directly to answer this question for American voters. We've started to see that on Venezuela with the $2 billion U.S. transfer of Venezuelan oil that President Trump says will bring down gas prices around the country. But we haven't seen that argument made in Greenland. We haven't seen it made with Iran. And that's going to really be a question Americans have. Americans broadly say, according to recent polling, that they disapprove of his handling of foreign policy. They do not want to see military U.S. action in Iran. Absolutely not in Greenland, and concerns about Venezuela, too.
Okay, Laurel, don't go anywhere, because we'll talk about Iran. In Iran, the Islamic Revolutionary Guard remain firmly in control amid the deadliest anti-government unrest in the country since the 1979 revolution. And even if protests come to an end, it seems the IRGC will play a pivotal role in what comes next. So let's get more on today's Bloomberg Big Take with Patrick Sykes, our breaking news editor in Istanbul, who focuses on Iran. So what are the scenarios, Patrick, and how does the IRGC fit into them?
Hi there. Yeah, we've pulled out a few key scenarios today in this big take. So one is a kind of leadership reshuffle that sees a strong man or perhaps multiple strong men emerge from among the elite. Second is a coup, a direct military takeover. Third would be a kind of slow decay from the existing uneasy status quo shortly before the protests. And as far as we see it, no matter how you cut it, in all of those scenarios, the IRGC is going to be key to whatever comes next. You know, think of the kind of the extent to which it has people active, current and previous members right across different branches of the state. Its status as the most powerful military organization in the country, far more powerful than the conventional army. And then the real turning point that we haven't seen happen also runs through them. That would be if we saw defections from the security forces, most significantly from the IRGC itself.
So what about ideology? If the IRGC is supposed to be protecting the system and the supreme leader?
Yeah, it's there in the name, right? The Islamic Revolutionary Guard set up back in '79 to protect that revolution, also to counterbalance the conventional military that was viewed with some suspicion. But since then, in part thanks to sanctions, in part thanks to the Iran-Iraq War of the 80s, and the way that Iran's economy has been constrained, their profile, their influence in everything from the economy, finance, oil trading, engineering, infrastructure, all the way through to I don't know, their conventional military capacities has just ballooned. So now they're a huge actor, far beyond their original purpose, and they've kind of increasingly captured the state that they were formed to serve. So that makes us think that, you know, that they care as much about their own interests, you know, personally, institutionally, as they do about the revolution. It's the ideology to draw on if needed, but it's not, I think, the limiting factor that their name suggests it might be.
All right, Patrick, thank you so much. Patrick Sykes, Bloomberg's breaking news editor in Istanbul. Laurel, when you look at everything that's happening in Iran, you know, the president of the U.S. saying there could be strikes, there are no strikes. Like, what is this symptomatic of? Does the U.S. really want to get involved?
President Trump did get involved last summer against naysayers and those that said a strike on Iran's nuclear capabilities would be too risky. Those voices were proven wrong in his view. He was able to degrade Iran's nuclear capability, unclear to what degree, how soon it can, or if it would be rebuilt. But he likely brings in a lot of confidence to Iran right now to say we can do things there without major U.S. risk to our interests. We'll see now what this looks like. We are in a very heated, a very high-wire act here in Iran. Seems the president has stepped back a little bit in the last couple of hours or days, but he is quite bullish on the expansive role the U.S. can have in the world. We haven't really seen him in other conflicts be quite interested in supporting human rights and democracy. Protesters, we're seeing a little bit of that here, and that's likely not the driving motivation. It's more of a U.S. power projection, and if we can do it, maybe we will attitude. But the days and weeks ahead will be critical here.
Laura, I mean, Venezuela and Iran, of course, it's oil, but this also means that you're really antagonizing China because, especially in Iran, they're the biggest, buyer of Iranian crude. So how does China? I mean, how does U.S.-China play out? I know there's been like easing of tensions towards the end of the year, but could this be really flared up?
U.S.-China relations, we've seen so many headlines in the past couple of weeks alone, but they haven't centered around U.S.-China tensions. And that is a theme that is a through line through all of these pieces. President Trump reportedly will go to China this spring to meet with President Xi. And President Trump is always looking for leverage and power and improving his negotiating position. And all of these moves will feed into those conversations about this expansive role for the U.S. in the world, of the U.S. being unafraid to use military force around the world. And that is potentially a way that the U.S. may see to improve its negotiating position with China.
Laurel, I mean, there's also so many questions about whether this is being done, and we touched a little bit about affordability in the U.S. and the fact that, the President Trump is not very popular at the moment, if you believe the polls, which maybe some don't. But there's also, everything that's happening with ICE and immigration. Does he have support for that? Or is he going also for foreign policy as a distraction of what's happening at home?
According to recent polling, Americans are widely disapproving of his handling on foreign policy matters. They've given him slightly more latitude on immigration. The country's very divided right now on how this president is handling customs enforcement. We've seen these very shocking images out of Minnesota with the death of a civilian there, a mom of 3 children. And so the immigration crackdown is escalating in the U.S. The White House may see that as an area that they can move a little bit more freely. But from an international perspective, when you look at the U.S., these sorts of moves are only driving polarization and are creating a very tense domestic environment right now.
Laurel, thank you so much for everything. Laurel Rapp, Director of the U.S. and the North America Program at Chatham House. Coming up, what does it mean to build an aspirational brand with commercial viability in 2026? Next, we change tack away from foreign policy. We talk luxury and the luxury sector. That's next, and this is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time,
helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise,
with some fun along the way.
This is Bloomberg Surveillance.
Next week, live from the Alpine Mountains of Switzerland, it's the World Economic Forum annual meeting in Davos. Bloomberg Television brings you unmatched coverage and conversations with world leaders, business executives, and billionaires as they navigate responsible AI deployment, economic expansion, and geopolitical tensions. Tune in for daily coverage all next week. Context changes everything.
Well, traders in the Japanese yen are on edge for the risk of renewed volatility with uncertainty over snap election and the BOJ decision next week. The yen hitting its weakest in 18 months earlier this year on expectations of an early election. Well, Bloomberg Originals has been looking at how consumers and businesses are coping with rising costs due to a weaker currency and what it means for the future.
In 2016, this Japanese company issued a public apology. For the first time in 25 years, they were hiking the price of a popular ice cream by 10 yen, or about 6 cents. And they were deeply sorry. Now, in any other country, this might have been an overreaction. But in Japan,
inflation is just completely alien as a concept.
For 3 decades, the country saw stagnant or even decreasing prices, which is why a 10 yen price hike for an ice cream was such a big deal. But a huge slide in the yen is helping change that picture. And it's causing a seismic shift in Japan's economy. The yen has weakened against the dollar to a level not seen since the early 90s.
The weaker yen means higher prices for all sorts of imported goods, from groceries to gasoline.
It's also making it pretty attractive for inbound tourists looking for a cheap vacation. Steering the country through this once-in-a-generation cost of living crisis is the inaugural challenge for Japan's new leader.
Sanae Takaishi has been voted in as Japan's first female prime minister.
Japan has arrived at that big moment where there's a potential transformation of the entire society.
Well, subscribers can watch that documentary right now on the Bloomberg Terminal and on Bloomberg.com. It's also available on Bloomberg Originals YouTube channel. Now, if earnings are anything to go by, yesterday's strong results from jewelry conglomerate Richemont show that the luxury sector is in rude health. Yet earlier this week, luxury retailer Saks filed for bankruptcy after failing to make a merger with Neiman Marcus work. So what does it mean to have a successful luxury brand in 2026? And how important are physical stores these days in building brand presence and driving sales? Well, we're delighted to be joined by Erwan Romberg, a global head of consumer and retail equity research at HSBC, and with us, well, with me here in the studio is Andrew Felsted, Bloomberg opinion columnist. So thank you both for joining us. Erwan, just give me a sense of how you think luxury will change in 2026. Like, what do people have enough money to buy for, luxury, or do they find it too pricey and expensive because it's risen so much? And is it jewelry or handbags that people want?
So thanks a lot for having me, and good to see you and Andrea today. You've had 2 years of very muted sales growth, 2024, 2025, with notably, to your point, the aspirational consumer being priced out. We wrote a lot about greedflation, the idea that many brands went too high too quickly in terms of price points. And very clearly, this was an issue more on the fashion side, so handbags and accessories, than it was on jewelry. So as a consequence, jewelry ended up being a lot more resilient, and handbags and accessories were under pressure. But alongside that greedflation, I think you also had a lack of creativity. And one of the reasons we're more constructive, despite listening to your program and being a bit stressed out about the world, is that I think you're seeing a lot of new initiatives in terms of product, in terms of pricing, to basically have that aspirational consumer who disappeared over the past 24 months come back somewhat. So we've been bullish, optimistic, constructive on jewelry, but we do believe that certain handbag and accessories brands will come back this year after, again, 2 years of misery.
Yeah, and Andrea, I mean, we love a bit of jewelry. I don't know if we're like the target audience, but we do like looking at it. The biggest surprise for me was over the last couple of quarters, actually, luxury is back.
Yes, indeed. It does seem that we are sort of through the worst. China seems to be stabilizing. The US consumer, particularly the wealthier consumer, is spending again. And what was notable with the Richemont numbers is that they compared with a period a year ago when we were all very upbeat on luxury because we'd had the US election. That seemed to unleash a wave of spending among US consumers. That sort of came to a halt with tariffs. But Richemont showed that it's, even with those tougher comparisons, those that are doing well are still doing well.
Erwan, you like Richemont, you like LVMH. What does LVMH have going for it?
I think LVMH, well, what it has going for it is positioning, in the sense that investors will be hiding in Hermès, will be hiding in Richemont, but I don't know a lot of investors who are buyers of LVMH, and I think if there are indeed signs of life, that will be the first one that investors will start looking at because it's liquid, it's a very large cap in Europe, and it's seen as a proxy. What is very specific to the LVMH story this year is what we believe will be a quasi V-shaped recovery for Dior. Talk about lack of creativity and and maybe overpriced products. I think Dior had become a bit stale over the past 2-3 years. It had become a bit repetitive, and you didn't have a lot of incentives to push the door. I think you've had a lot of management changes happening there. You've had a few product initiatives, and no one's a savior, but you do have the arrival of a very gifted creative director, Jonathan Anderson, who is working wonders at Loewe, another of LVMH's brands. And I think there's a lot of excitement. I mean, you saw a sort of revolving door of designers, a change at Chanel, a change at Gucci. This change at Dior, I think, will move the needle quite significantly. It's only starting now. None of his products were in store in 2025, but you already had signs of an increase in traffic, in interest for the brand. And I think that will translate into very strong growth for Dior. Now, obviously, the key asset at LVMH is Vuitton, which is about half of profits, and Vuitton is also doing okay. But Vuitton is very big, so it was probably slightly down next year. It'll be slightly up this year. Dior, in terms of recovery, I think will be a lot more visible.
Yeah. And this is what you were saying, Andrea, is that, I mean, it's really a tricky sector because so much depends on the creative director and whether, kind of what appeals to people, which is something so soft. You can't really put measures on it.
Exactly. And as Owen says, we've got this sort of period coming up sort of over the next few months, which is going to be the big test. We've got with Dior, Gucci. The next show for Gucci will be his first outing. He had the crazy film back in the autumn, but the first proper show will be in a month or so. So it's going to be really a test, and it's really going to see whether handbags and leather goods can steal back some of those sales from jewellery.
Are we still in the quiet luxury phase, Andrea?
No, I think quiet luxury is over.
So where are we?
I really do. I think we're in the death throes of quiet luxury, but I don't think we've yet come back to maximalism. We're definitely smartening.
We're in purgatory. We're not sure where we are.
We're definitely smartening up, and there are signs of some, more ostentatious luxury flourishes. Obviously, we've got Gucci. Demna sort of hit on a few of the sort of typical Gucci things, like the logos. So I think we're in the death throes of quiet luxury. I don't think we're quite yet back at maximalism yet, but I keep reading that after the 90s, the 80s is the next decade to have the nostalgia. So we could see
the flare pants and the metallic
shoulder pads, cinch waists. So maybe the 80s will bring back some power dressing.
And Andrea, it's always the U.S. consumer, right? That's still the most important person.
The U.S. consumer and China.
And China's back?
China's stable. I'm not sure if it's quite back, but it's going hopefully in the right direction.
Yeah, Erwin, what are you seeing in China?
Yeah, I think to Andrea's point, China is stable, but stable is the new up, right? Because not that long ago, China was down double digits. You have two engines of growth, to be fair, in the luxury space. The Chinese are somewhat still, depressed, linked to the property market, linked to youth unemployment. But as a CEO in the space told me not that long ago, you can't be down 25% on 25% forever. At some stage, you find a level. Yeah. I think there's a lot of negativity and this perception that Chinese have lost interest forever in luxury is factually wrong. And then the other engine of growth is the U.S., which is more related to equity markets. And here, there's a nice correlation with luxury demand.
We're on a tear for the moment. Erwin, thank you. Erwin Humble, Global Head of Consumer and Retail Equity Research at HSBC, and, of course, Andrea Felsted from Bloomberg Opinion. A reminder, our special coverage of WEF starts on Monday. We'll be live with the Pulse there all week.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
A cidade estava sitiada.
Isso, ao começo, eu também não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People become the suffering
and someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
It's 5 a.m. in New York City. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Making big tech pay. President Trump pushing for an emergency wholesale electricity auction designed to make tech firms pay for power. Better terms? Taiwan's trade deal with the U.S. prompts concerns its tech industry could lose its economic edge. And stocks extending their record rally after TSMC results spark confidence that the durability of the tech momentum will continue and sustain. So to that end, let's have a look at futures because they are pointed to a higher open today. We saw decent selling into the close yesterday. Nevertheless, the indices were higher, about 1/4 and 1/3% for the S&P and NASDAQ 100, and also, of course, the Russell 2000, which continues to outperform the S&P 500. I do want to point to some headlines that we just got a few minutes ago between Mark Carney and China's Premier Xi Jinping. A new trade resetting there, some very interesting details to do with canola oil, visa-free travel, electric vehicles in particular. So we'll see what kind of a response that prompts out of the U.S. later today. Let's take a look at the bond universe, because we are seeing the front end come up interestingly. So we're at 356.29 here. Meanwhile, the 30-year yield is still at 4.80. Now that 2-10 spread is down more than 10 basis points this year alone. So we're at about 60 basis points plus right now. So definitely a little bit of flattening, particularly at the front end. And I want to point to gold as well, because it continues to be above $4,600 an ounce. All right, let's get to some individual movers. This Friday trading session, we'll get across to London and Chloe Melly.
Good morning, Bonnie. It looks like yesterday's tech rally has still got legs today, and we are seeing shares in memory chip, memory card makers, SanDisk and Micron move higher in pre-market trading today after a really good day yesterday, which was, of course, as you mentioned, on the back of TSMC's really upbeat outlook, which reassured investors about this AI demand and capital spending continuing there. Moving on to the printing business, to HP, which doesn't look as exciting, that printing business, as the chip equipment business. HP was downgraded by Barclays just after being downgraded by CFRA, with analysts noting rising costs and anemic growth for that company. And so we are seeing the shares move lower this morning. And finally, let's go over to Europe, where Volkswagen is also in focus, because this is the parent company of Porsche, and Porsche deliveries fell the most since 2009, since 2025. So Volkswagen, the parent company shares, are therefore down this morning on the back of that weakness in Porsche, which has been dealing with tariffs and the really difficult rollout of its electric vehicles as well.
Chloe, thank you for that. That is Chloe Melly there in London. Coming up this hour, global credit markets running hot. We'll discuss more with Henrietta Packman, of Allspring Global Investments. President Trump is pushing for an emergency auction for tech companies to bid on 15-year contracts for new electricity generation capacity. Joining us now is Matt Bloxham of Bloomberg Intelligence. So what prompted this move, which, by the way, hasn't happened yet, but we are expecting it to be made formal later today?
Yeah, well, I guess if you look over the last couple of decades, residential energy prices in the US have been moving up. They're now almost 20 cents per kilowatt hour. In the early 2000s, kind of down in the 8 to 10 cents kilowatt hour. And obviously, quite a politically sensitive issue in the US with midterms on the horizon, and the cost of living, a kind of thorny issue. So I think and the big pressures come from this massive expansion in data center capacity, sucking huge amounts of energy, and shifting that kind of supply curve, and obviously bringing new power on stream is a kind of long-term investment. So I think this is an interesting mechanism to try to kind of bring some certainty for the power generators that there is demand. And so essentially looking for the data center operators to kind of commit to the 15-year purchase contracts, whether they use the power or not. So I think it's a way to try to kind of create a kind of two-tier market and protect the residential supply more effectively than we've seen so far, so that they can perhaps even bring pricing down.
Now, Matt, the president very concerned with the idea that each data center should have its own power source, right? Does this get around that somehow? Because that's not really doable in the near term, from what I understand.
I think it certainly looks to me like another mechanism to try to kind of deliver the same goal, which is that there's self-sufficiency from the data center market in terms of power delivery, and they're not putting unpredictable and excessive demand on the kind of more kind of consumer and an enterprise grid. So it's a slightly different mechanism, but ultimately looking to kind of deliver the same end goal. Obviously, a lot of big companies like Meta looking at small nuclear reactors to build alongside their data centers. So I think we're going to see a number of different mechanisms to kind of deliver on these growing power needs.
And then I suppose the question is, does it benefit big tech more than small tech? Matt Bloxham of Bloomberg Intelligence, thank you so much. Sticking with tech, the US and Taiwan have agreed to a trade pact that would lower tariffs on goods from Taiwan to 15% from a previous 20%. Taiwan then would commit to making at least $250 billion in direct investments to expand advanced chips, energy and AI operations in the United States. Bloomberg's Annabelle Jewellers now joins us from Taipei. So Annabelle, this new trade deal, how much of it exactly is new? Because we had heard about many investments in the United States from Taiwanese companies already.
Yeah, that's right. I mean, really, when you think about the key company here, it's, of course, TSMC. They're the most dominant chip maker, essentially not just on the island, but globally. And already they've committed around $165 billion to building out their infrastructure in the States. So, yes, of that, potentially it already goes into that $250 billion that's of direct investments that you just mentioned there that have been inked in this trade pact between Taipei and Washington. But still, just to sort of recap the main takeaways from that, I mean, it's very significant. It's been months in the making, and looking at lowering those tariffs from 20% rather to 15%. So essentially bringing Taiwan in line with what Korea and Japan managed to negotiate last year. So yes, $250 billion in direct investments, an additional $250 billion in credit guarantees as well to try and build out or further investments into the American semiconductor supply chain. But exactly what that looks like in terms of how big TSMC is willing to go in the States, that's unclear, because we've been reporting this week, for instance, that they were looking at adding 4 fabs or 4 additional fabs to the 6 that have already been committed or promised to the States. Unclear essentially of how much they're willing to expand at this point in time, and their capacity to do so, given each fab costs around $20 billion to build, but takes 2 or 3 years to build as well.
Exactly. Now, you just had an interview with the CFO of TSMC, a fascinating interview. Tell us a little bit about what he said and, whether he's enthusiastic about this arrangement.
Yeah, well, this was a really great timing, of course, for a conversation with the CFO of TSMC, Wendell Huang. It came just after the company as well reported their earnings and very strong earnings for the fourth quarter, very strong guidance as well going into 2026. And what was really interesting was that CapEx pledge as well, because they're looking to spend between $52 and $56 billion in 2026. That's a substantial increase from where we were in 2025, also 2024. Exactly how much they put into the US is one of the key considerations and key unknowns, even though I did, of course, ask him about that. But it is also sort of unknown how much advanced technology can actually be built out in the US, given that the ecosystem in Taiwan and the expertise here, again, is just so unique to the island. But take a listen to his comments on that.
We don't look at it this way. It really depends on customer demand. In the US, a lot of customer wants to go there, so we will expand over there. But for the leading edge technologies, it will be in Taiwan because it's a heavy cooperation between the R&D people and operation people for practical reasons.
And leading edge will continue to be led by Taiwan, you think, over the US market, and that no changes to that at all, even with you adding a lot more capacity in the States?
Yeah, that's for practical reasons.
Is it possible, though, to speed up how quickly that advanced tech can be shifted from Taiwan to the States?
Yeah, we can try to do that, to shorten the gap.
What does that transfer gap look like then? If right now it's several years, Taiwan is ahead, what does that actually look like in the future?
We don't have a specific timeline now, but we can try to accelerate that. We think we can try to accelerate.
Could it be shortened to months, do you think?
It will be difficult, challenging.
Okay, so it stays at least one year behind then. Yeah, so really interesting there, those comments from Wendell Huang. I mean, there is a tech gap and it seems like it's going to be persisting. There are challenges, of course, of building up in the US, as I said, around labor specifically. Taiwan has these science parks, again, that are unique to the island as well, and you don't really see that, of course, in the US right now. So, yes, it's been a big vote of confidence, so overall from the company in terms of the outlook for AI spending, because they're saying that they've spoken with the customers, they're customers of customers, they're confident in their CapEx spend as well, because they do see AI demand being real. And it's just interesting to see how much that really played into the market session in Europe, the US on Thursday, Asia today and Friday. And again, you see it already in futures ahead of the open for the NASDAQ this morning.
Exactly, giving life to this market. Annabelle, thank you so much, and thanks for bringing us that interview. That is Annabelle Drulers, co-anchor of Bloomberg Tech Asia. Now to all the top stories trending on the terminal this morning. Global credit markets are running at their hottest in 2 decades. This has prompted money managers, including Aberdeen and PIMCO, to issue warnings against complacency. Based on Bloomberg data, yield premiums and corporate debt have narrowed to 103 basis points, the narrowest since June of 2007. China is clamping down on high-frequency traders by removing their servers out of data centers at local exchanges. The change will impact the speed advantage they've had to beat rivals. Citadel Securities, Jane Street and Jump Trading are among the foreign firms whose access to servers is being affected. And China and Canada easing trade tensions. The nation reached a wide-ranging agreement to lower trade barriers, including a reduction in tariffs for Canadian canola oil and Chinese electric vehicles. Coming up, Greenland rallying U.S. lawmakers to head off President Trump's demand for more territory. More next. This is Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersachi in Beirut, and this is Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Sides agreed to really establish a working group of individuals who will continue to have technical talks on the acquisition of Greenland. Those talks will take place, I'm told, every 2 to 3 weeks. So this is a conversation the administration intends to keep having with the Danes and with the respected delegation from Greenland. But the president has made his priority quite clear. He wants the United States to acquire Greenland. He thinks it's in our best national security to do that.
Greenland and Denmark ramping up lobbying efforts to seek U.S. congressional support now against President Trump's bid for the Arctic territory. For more, let's bring in Bloomberg's Oliver Crook. So, Ollie, we've had a week of diplomacy. Where do we stand, given that Caroline Leavitt was just talking about a working group to acquire Greenland?
Yeah, absolutely, Vani. I mean, the week really began with the German foreign minister on Monday in D.C. trying to have a discussion with the sort of various members and the stakeholders in the United States to try to get some buy-in into sort of collective Arctic action within Greenland. This is something that didn't get a whole lot of traction within D.C. in those conversations with Rubio. And then it obviously was the Danes and the Greenlandic foreign ministers who had their conversations in their turn. And after that, really nothing has been resolved as we sort of close out this week. It is encouraging, at least from the Danish perspective and the European perspective, that there is engagement between the United States and them on this diplomatic level. But again, when we think about what we've got out of this week concretely, the first is what you've heard there from Caroline Leavitt, this working group that has been established that'll meet every couple of weeks between the Danes and the United States. But we should say that the mandate of what that group is actually meant to achieve is very different in the mind of Caroline Leavitt. You heard it from her there saying that it's continue to have technical talks on the acquisition of Greenland. The Danes see it more as an opportunity to talk about collaborative efforts in Greenland. They don't see that necessarily as conversations for them ceding Greenland. The other thing that's happened this week, Vani, is this delegation of different military personnel from other European countries going into Greenland that began this week. So a coalition of different nations from France to the UK, Sweden, Norway, all of these countries sending very small numbers of sort of military personnel, really liaison officers, and part of the rubric for these exercises that will be happening in Greenland called Arctic Endurance. But we have to say, Vani, if we went into the week very concerned about the fraying nature and the stability of the NATO pact, we come out of the week not terribly reassured here on the European side.
Yeah, I mean, what kind of a scene is it, Ollie? You have NATO troops, as you say, at the moment, small numbers, but basically NATO's troops going into Greenland, and we're just getting headlines now that NATO's chief, Mark Rutte, will meet with the Danish and Greenlandic foreign ministers Monday. I mean, they're building up a presence for a reason, right?
Yeah, but again, right now it's a very sort of small presence. So a couple of soldiers for a number of countries. I think the biggest sort of numbers that we're getting are from the Germans. I think it's about 13 soldiers, and the French about 15. But then Emmanuel Macron speaking yesterday in quite strong terms about basically the fraying alliances and the sort of now threats that are being posed by effectively the United States. He didn't say it quite as explicitly to the Europeans. It's something that he's taking very seriously. He says that there will be more troops sent from France on the ground, in the air, and in the sea in order to sort of buttress buttress the sort of support within Greenland. We should say that this is not really being framed by the Europeans actively as trying to deter the United States, though it's certainly, I think, part of their calculus in their discussions. But there's also a sort of strong effort by the Danes, obviously on the highest diplomatic level with the Trump administration, but they also made the appeal to the American people directly. I mean, the foreign minister of Denmark went on Fox News. It's no accident that he went on to Fox to basically make the point that the Danes have always followed the United States. I mean, one of the stats that's bandied around widely is that they lost more people per capita in Afghanistan than any other sort of NATO ally, to really sort of try to sell this to the American population. And we should say that bipartisanly, overall in the United States, there is not appetite, public support for an invasion of Greenland. About 86% of Americans would oppose such action, mostly, obviously, Democrats and independents, but even among Republicans, 68% would not want a military intervention in Greenland.
Oliver Crook, Chief European Correspondent. We'll see what next week brings. Thank you so much. Coming up, all options on the table. The U.S. tells the UN on Iran in an emergency meeting. More on that and what else is making headlines in your front page news next. This is Bloomberg.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Bloomberg Brief. I'm Bonnie Quinn in New York. Heading over to Michigan now, Bloomberg Open Interest anchor Matthew Miller sat down with the Ford executive chairman Bill Ford on the sidelines of the Detroit Auto Show. Take a listen.
We're adding jobs even as we're sitting here today. So we're growing as a company. Our market share is growing. Our products are incredibly well received. But I'll say this. The government, and I've been saying this for years, and thankfully people are paying attention now, we were in danger of losing our industrial base as a country. And what we found out during COVID, I think what the world found out is when we started making respirators and ventilators, which other companies could only make a few a month, and we could make 1,000 a month. They realize that there are companies that can make a lot of things. There are companies that can make complex things, but there are very few companies that can make a lot of complex things, and we do. We integrate software into hardware. We turn out an F-150 every 53 seconds out of our Rouge plant. And, and there are very, very few companies anywhere in the world that can do that. And so I'm very happy that our government, not just the administration, but actually Congress as well, has realized that that really matters.
One of the things that we've heard about this administration is, regardless of what you think about their policy, they pick up the phone when you call. And I know that Jamison Greer is meeting some people in Ohio tomorrow. Yep. Are you going to be going there? And
I'm not, because we're right in the middle of the auto show. But yes, we'll have our people there. I mean, this is a crazy week. We've got the Detroit Auto Show, and tomorrow's the big opening of that, which I will be at. Today's Ford Racing. We had, as you mentioned, we had the president 2 days ago. So yeah, it's quite a week for us. But yeah, Jamison Greer and others from the administration will be touring our Ohio Assembly, and I think that's great.
The reason I ask is that Jim Farley always says, this is the most American car maker that there is, and yet some of your competitors may be getting an advantage if they build their products in South Korea, for example, or in Japan, because then they only pay a flat 15% tariff. Can you work with the administration so that Ford doesn't get hit harder than others that are building out of the country?
Yes, we are. And I also think this. We were the most American before there were ever tariffs, or anybody even thought about tariffs. Well, why is that? Because we paid a penalty versus the companies that were building in Mexico and elsewhere and bringing them in. But it's part of who we are. I feel very proud of what my family is. I'm only the fourth family member to be at the head of this company. And to me, building in America was something that I always wanted to do. And even when some of our executives would say, we shouldn't do that, we should move more jobs overseas, I always said, no, we're going to build here, and we're going to build in our hometown of Detroit, Michigan, and in Michigan, but we're going to build elsewhere in America. And as I say, that was something that was important to me, even though we paid a price for it, and that was long before anybody ever talked about tariffs.
That was Ford Executive Chairman Bill Ford in conversation with Bloomberg's Matt Miller. Time now for your front page news. First up, the Associated Press is reporting the U.S. envoy to the United Nations renewed threats against Iran at the UN Security Council, saying all options are on the table to stop the slaughter of protesters. Several Iranian dissidents called on the world body to hold Iran accountable for human rights abuses. Next up, the Washington Post reports the medical examiner in the case of a man who died in ICE custody is likely to classify the death as homicide. The Post cites a recording of a conversation between the medical examiner's office and the deceased's daughter. The office is listing the preliminary cause of death as asphyxia due to neck and chest compression. A fellow detainee said he witnessed 55-year-old Cuban immigrant Geraldo Lunas Campos being choked to death by guards at the Texas Detention Center. And finally, the Financial Times reporting the first U.S. sale of Venezuelan crude was to a company whose senior oil trader donated to President Trump's re-election campaign and attended a White House meeting with the president last week. The FT says senior Vitol trader John Addison donated about $6 million to PACs backing Trump's re-election. This is Bloomberg.
don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. Making big tech pay, President Trump pushes for an emergency wholesale electricity auction designed to make tech firms pay for power. Better terms? Taiwan's trade deal with the U.S. prompts concern its tech industry could lose its economic edge. And stocks extend their record rally after TSMC results spark confidence in the durability of tech momentum. So futures pointed higher then once again. Now, we did see very decent selling actually into yesterday's close, but we still ended up more than 0.25% higher on the S&P, about 1/3% higher on the NASDAQ 100, and the Russell 2000 continues to outperform. We'll see if that extends into today. Obviously, it's a long weekend with the Martin Luther King Day holiday in the United States on Monday. That may be having an impact on this selling that we saw into the close yesterday. But this TSMC result momentum continues. Let's take a look at the bond universe because we're seeing the front end come up. We're at 356 now, even more. And that 30-year yield down to 480, so definite curve flattening. We have the 2-10 spread back down to 60 basis points. That's a drop of more than 12 basis points just this month alone. And then you also see gold continues to be very close to its record set earlier this week. It's above $4,600 an ounce. Let's get to some individual movers to watch now. Here's Chloe Melly.
Good morning, Bonnie. As you just mentioned, yesterday's tech rally still has more room to run, and we are seeing this morning in pre-market trading companies within that memory chip sector, in particular SanDisk and Micron, move much higher. This is a continuation of what we saw yesterday with investors getting really excited about this momentum, this growing momentum in AI demand because of TSMC's numbers and also very upbeat outlook. And so we could see actually the rest of those chip equipment names move higher and be in the green this morning as the tech rally continues. Moving on to a very different sector, to food, because Kraft Heinz was downgraded by Morgan Stanley, with analysts mentioning that the U.S. food sector will face growing risks in 2026 because of pricing pressure and growing competition as well from private label. And so this is really dragging down those shares. We're down about 1.2 for Heinz this morning in pre-market trading. And finally, Porsche deliveries fell to the lowest since 2009, and that is really putting pressure on the parent company Volkswagen, and we are down 1.7% for Volkswagen this morning in Germany.
Chloe, thank you so much. Chloe Melly there in London with those movers for us. Global credit markets running hot. Money managers, including Aberdeen and PIMCO, are warning against complacency as corporate bond spreads are at their tightest in 2 decades. Henrietta Bachmann of Allspring weighing in, writing, quote, "We appear to be in the late stages of the credit cycle, but not quite at the end. It could be a few more years." She's head of global fixed income and she joins us now. Henrietta, anytime June 2007 is evoked, I mean, it prompts shivers down the spine, right? And that's where we're seeing spreads at right now for corporate bonds, those levels. I mean, is there nothing to be worried about at the moment?
These levels reflect the fundamentals that we're seeing at this point in time in the credit markets that are pretty benign. We have had a few credit stories if you look back into 2025, but they've been very contained. So there is a reason why these spreads are tight. I think added to that as well, obviously we're in a very different interest rate environment compared to the years following the financial crisis where the interest rate environment was very low. So investors are looking at pretty attractive all-in yields on the credit markets, even though, from a spread perspective, it's looking tight. Now, obviously, we're credit investors. We do make sure that we're looking at the fundamentals and we're keeping an eye out on the evolution of balance sheets. So this is an important time to do that security selection work.
Sure, and I hear what you're saying. There's a resilient economic outlook around the world and so on. Central banks seem to be fairly comfortable with where they're at. At the same time, we have companies issuing a record amount of bonds here in the United States with so much more to come, you would imagine, particularly around AI this year. Will demand hold up?
So I do think that investors are still searching for yield. I think also they're looking at the sort of frothy equity markets. So they are, looking at the sort of risk profile of their books. And I think that's helpful for fixed income because it can play its sort of role as a diversifier in that space. Yes, we are expecting a lot of issuance, particularly around the sort of AI play, and I will go sort of wider than just your sort of hyperscalers and so on. You can think of utilities. All of that is part of the AI story at this point in time. So definitely something to watch. And when you look at that, the sort of type of investment that they're making, really interesting to sort of see the power side, over the last couple of days and the requirement from the Trump administration in terms of financing there. The nature of the financing that they're doing at the moment is a little different than what they will have done historically. So you've got volume and you've got something a little different. So it is something to look at. That being said, if you look at the big issuers in the market, they're starting from a very strong place in terms of their balance sheet. A lot of them are in the sort of AA, single A space, a couple of exceptions, but they are starting from a very solid balance sheet.
Sure. Now, does that mean you'd be interested? And, are there areas you would avoid? You say they're doing something a little different. Does that give you pause?
So I think it really is a question of making sure that you're being rewarded for the risk. So when we're looking at those plays, typically we'll be looking at it in the new issue market, right? And making sure that there is a bit to play for on those new issues.
So what kind of spread would you be looking for? What would be the minimum that you would accept, let's say?
Well, minimum that'll depend on the name. That'll depend on the sort of tenors that are available. I think it gives us a lot of flexibility to really pick where we want to be in the curve as well, and to sort of have the right risk profile there. I mean, if you look at where we're particularly interested in terms of maturity profiles, we're probably a little sensitive to the long end. We've seen that sort of behaving over the last few days, but it is going to be a little more reactive to noises around central bank direction and also the fiscal concerns on that side. So our preference is actually onto the sort of shorter to intermediate side of the spectrum, and this issuance is going to give us plenty to play with.
Yeah, and it's fascinating. We have seen the short end come up a few basis points. I mean, small moves really, but just in the last couple of days. Well, what is the bond market telling you? Does this flattening continue, or do we return to the steepening that we had been seeing?
So I think if you look at what's been happening on the short end, it is sort of reflecting some of the uncertainty in terms of the speed and the number of rate cuts that we're expecting over the course of 2026. We've had some quite buoyant data over the last few days, and animal spirits are very much still in play. So I think it's a reflection of that environment at this stage. But as you say, these are small moves. The number of cuts and the pace of cuts at the moment that is pressed into the curve isn't bad.
So, Henrietta, it doesn't take much for the Treasury market to wobble. We've seen that a couple of times in the last few months alone, right? Is there enough fear underneath the surface that something small could create another tremor in the Treasury market, or is it pretty resilient at this point?
I mean, if you look at the sort of range of the 10-year, that's always an interesting one to look at. It's been pretty tight, actually, since the beginning of since the beginning of December. So that is good to see. There is a lot being potentially thrown at the Treasury market. You've got the fiscal side. I mean, we've still got a healthy deficit to fund in the US. You've got noises around sort of central bank independence as well that can play into the volatility there. And maybe adding in the AI theme, it's a favorite at the moment. You've got all the sort of pressure that is coming into power prices, and it'll be really interesting to see what that does to the pricing of power, and as a result, how it feeds into the inflation story. So you've got a lot of elements to look at that could create a bit of volatility, particularly on the long end.
And then, Henriette, I'm sure you've been concentrating a lot on central bank divergence around the world, right? Looking globally, where is an attractive space for you right now? We're seeing all sorts of movements with the Chinese currency, the Japanese yen, obviously, and also, China dipping into its markets to try and, shore them up.
Yeah, so I think definitely we're seeing divergence in terms of the interest rate environment across the globe. So what we're looking at in the portfolios that we run is to have some diversification across the different interest rate environments to capture some of that diversification. If you look at bond portfolios, that diversification can be really beneficial. Areas that are particular interest are the European interest rate markets. At this point, if you look at the sort of cuts being priced in, there's really not much. When you look at 2026, you're benefiting from, if you look at it on a hedge basis, from a pickup in terms of the hedge there. So that can be quite an attractive beneficiary and area to look at.
Henrietta, an absolute pleasure to speak with you. Thank you so much for your time today. That is Henrietta Bachmann of Allspring Global Investments. Now to other top stories trending on the terminal this morning. JP Morgan is looking to add deal makers in Europe as it predicts a bumper year for M&A this year. JP Morgan's co-head of global banking, Philip Ogori, said that they're hiring in every country across the region. Investors in Southern Europe are particularly confident about the M&A outlook. Veteran investor Mark Mobius is shunning gold. He told Bloomberg it has become unattractive after its historic rally and warns that a potential rebound in the dollar could undercut precious metals. Mobius says he would consider gold if prices were 20% lower than today's levels. And China and Canada easing trade tensions. The nations reached a wide-ranging agreement to lower trade barriers, including a reduction in tariffs for Canadian canola and Chinese electric vehicles.
It's expected that within 3 years, this agreement will drive considerable Chinese investment in Canada's auto sector, creating good careers in Canada and accelerating our progress towards a net zero future and the auto industry of the future.
That all just coming in the last couple of hours. Coming up, President Trump aims to have tech firms fund new power plants. More on that next. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump and several state governors have agreed to an auction to compel tech companies to effectively fund new power plants. This as the president wraps up his affordability efforts while electricity costs hover at records. Liliana Byington of Bloomberg Government joins us now from Washington. So it's obvious what the push behind this is, Liliana, but how will it work? Can the president and these state governors force companies to bid on electric power on the grid?
That's the agreement they're trying to make today. If there's something that President Trump and a bipartisan collection of governors have found that they can agree on, and it's to try to force these tech companies to foot the bill for these increase in electric prices. You know, AI is something that the president wants to be a leader on in the United States, and so what's needed for that is these data centers. But these data centers are pushing up the cost of utility bills, and so the thing that they have found that they can agree on in this time is that they want to push those prices onto the tech companies, want to force them to pay, and that's what this auction is hoping to do. You know, one of the things that will be interesting to watch today at this event at the White House is who won't be there, and that is JPM. And so that's you know, something we'll be watching today to see how it's going to work going forward.
Yeah, PJM is actually the grid operator, right? Do they have a say in the matter, or do they care who bids on their electricity? I mean, essentially, if 15-year contracts are paid for, then the volatility shouldn't happen as much, right, price-wise?
That is my understanding as well. And, you know, with PJM operating the grid, you know, the governors will be from 13 states within the PJM grid. So this is, you know, aiming at them. But, you know, they have said that they will not be here at the event. They're not commenting yet. And so there is still a lot of questions around how this is going to work going forward. But this is an agreement between the governors and the president. And so we'll have to kind of see how it's going to work.
Yeah, we'll hear more later today. Now, outside of the U.S., we've clinched a deal with Taiwan to cut tariffs. In return, Taiwan boosts chip investment. How is this being viewed by both sides, Liliana?
Yeah, I mean, President Trump took a big swing with his bet on tariffs, and so this is one of those agreements that he does need to kind of show that he's making progress on this. The deal would lower tariffs to Taiwan to 15%. That's from 20% that he set them at. And so this is kind of a big bet. It took months of negotiating to get to this agreement. And so it's definitely a big deal for Taiwan too. But right now, Taiwan also has to sell it to their public. You know, Taiwan invests a lot of revenue and jobs when it comes to their chips industry. And so this is a big deal for them, and they have to kind of sell it because it also has implications for its relationship with China. Their semiconductor industry is something that kind of shields them in their relationship with China. So they have to now sell this agreement of this big investment with the United States to their public too.
Liliana Byington of Bloomberg Government in Washington, thank you so much for joining. Greenland and Denmark lobbying to seek U.S. congressional support now against President Trump's bid for the Arctic territory. Bloomberg's Suzanne Lynch joins us now for more. Suzanne, diplomatic meetings all week in Washington, D.C. Is the U.S., even through congressional support, open to anything less than acquisition here, ownership of territory in Greenland?
Well, I think it's still very unclear from the European perspective exactly what the intentions of President Trump are when it comes to Greenland. We had that meeting between the Danish and Greenlandic foreign ministers and J.D. Vance and the Secretary of State, Marco Rubio, earlier in the week. But really, that was pretty inconclusive from the point of view of Denmark. Now, there was some positive signals. A discussion group was set up, if you like, but still unclear about what the intentions are. But as you say there, today, in the last while, we have seen a delegation from the United States Congress, including 2 Republicans, arrive in Copenhagen for talks. So that's going to be a lot of focus here today. Obviously, the Danish Prime Minister, the Danish government, going to be making sure that their perspective is put across to these senior members of Congress. Chris Coons, obviously one of them, but also 2 Republicans, including Lisa Murkowski, the senator from Alaska.
Suzanne, I want to ask you about Iran as well, because the president said that he had been promised that the killings were stopping. Do we know anything more out of Iran? Has Elon Musk been able to grant internet access in any way, or any more intelligence, or been able to shine light on what's going on in there?
As you say there, Vonnie, that's one of the big issues, this internet outage now that is going on for days, much longer than we have seen before from this country. So very difficult to get a picture of what's happening in there. And indeed, as you say there, most of this information we're getting is from Donald Trump himself. We heard the White House press secretary saying yesterday that, the Iranian regime had agreed not to execute protesters. So at the moment, various reports are suggesting that the Trump administration for now has been persuaded to hold back for the moment. People are keeping an eye closely on various U.S. assets and where they're positioned in the world at the moment. Obviously, a lot of activity around South America, Venezuela, but whether the U.S. would be in a position to move forward on this in any way. But look, European diplomats and centres of power here in Europe watching very closely about what's next for Iran. But at the moment, it does seem that as we speak now, there are signs that the U.S. and Donald Trump has been persuaded by some actors in the region not to act for now, at least.
All right, Suzanne, thank you so much. That is Suzanne Lynch there in Brussels. In the latest episode of Peer-to-Peer Conversations, Bloomberg host and Carlyle co-chairman David Rubenstein spoke with JP Morgan CEO Jamie Dimon. Have a listen.
JP Morgan Chase does well. I can help our employees, I help my clients, I help my communities, I help my country, I help the world if I do a good job. I always tell people, if we don't keep JP Morgan healthy and vibrant, I cannot do those things. That's really the other side of that. Got to lay people off. It's miserable. Your life is terrible. And so I fight hard to make sure we're healthy and vibrant.
Now, you flirted at times with maybe running for president of the United States. Are you still thinking maybe you would ever do that?
I never really flirted with it. Oh. I simply asked someone once, what does it entail?
Okay.
And they told me. That was it.
All right.
It entails a lot. It is a huge thing, but I love what I do, and this is what I intend to be doing.
Right. Suppose a president of the United States said, I'd like you to be Secretary of the Treasury or Chairman of the Federal Reserve Board. What would you say to that?
Well, Chairman of the Fed, I'd put in the absolutely, positively, no chance, no way, no how for any reason.
Okay.
Secretary of Treasury, I would consider, if a president calls you up and asks you to do something, you should consider it. So I would take the call and consider it and think about why and what they want, et cetera. But what they want and how they want to operate, that would be important to me. I like my job. I've been my own boss for pretty much 25 years, and I like it that way. I was in Peru at the APEC meeting or something like that. I was coming on stage like this, a televised thing, And as I was walking up, the person that questioned me, I think it was from Bloomberg, said, the president just tweeted that he likes you or something like that, but you're not going to be Secretary of Treasury. And she asked me on national TV. So I said, that's good because I like being my own boss.
And you can watch more of our interview with JP Morgan's Jamie Dimon on The David Rubenstein Show, Peer-to-Peer Conversations, airing January 21st at 9 p.m. New York time. Coming up, more Fed speak ahead of the long weekend. Your day ahead is next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. So we have Fed speak throughout the day. Collins, Bowman, Jefferson, they're all on deck. Plus a press conference with the leader of the Iranian Democratic Opposition in Washington. That's at 10 a.m. Eastern. And U.S. markets, of course, are closed on Monday for Martin Luther King Day. Don't forget, not that you would. Let's take a look at the macro environment as we go into the final trading day of this week. We'll start with the metals, of course, and crude. As you can see, we're holding on to our below $60 a barrel price. This after the relief on President Trump holding back on Iran for now. Gold is lower, but it's just off its record, which was set earlier this week. It's still above $4,600 an ounce. And silver is sticking around that $90 mark. Got up to about 96 and pulled back, but it's holding there. S&P futures pointed higher this after gains yesterday. It's all about the Russell 2000, though, these days, and the SOX, which continues to hit records. The dollar index just down about 0.1%, and that 10-year yield at 4.17. Worth watching the 2-year yield, though, because that is rising ever so slowly. That's it for Bloomberg Brief. Surveillance continues the conversation. Thanks for watching. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
The corporate sector is doing great.
It's all about earnings.
The headline on 2026 is noise continues to be noisier and ratcheted up.
I think investors, to be fair, are keeping their eye on the ball.
There has been a lot happening in the face of what has been largely a resilient equity market.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, the equity market rally broadens. Small caps beating the S&P 500 for 10 consecutive sessions as President Trump is pushing for tech companies to fund new power plants, and Federal Reserve officials are lining up to hit pause on rate cuts one day before the Fed goes silent.
And it makes sense given what we've seen in terms of the data, especially the economic data. Look at the jobless claims yesterday. The Fed has cut rates at each of the final 3 meetings of 2026. And now there's this inclination that maybe it's time to stop, take a breath, and hit pause for a bit. That's what I heard with New York Fed President John Williams earlier in the week. He was speaking on Council of Foreign Relations. I was there, Jonathan, in the audience, and there wasn't a sense of urgency that he felt the Fed needed to act.
You've seen that echoed on Wall Street this week. Mike Feroli over at JP Morgan, no rate cuts this year. We'll catch up with Stephen Stanley of Santander, also in the camp of no rate cuts this year. And Morgan Stanley's Mike Apin saying this about consumption. The data's better. He says consumption is overshooting. He expects it to continue.
That's what a lot of people are saying, that the consumer is resilient right now. We heard that on all the bank calls this week as well, coming from Bank of America and other C-suite executives, as well as what you see from the individuals like Torsten Slok. This potential tailwind risk of 2026 overheating. You have the one big beautiful bill, a huge fiscal impulse because we're heading into a midterm election.
You mentioned the banks. Let's talk about the banks. So the performance this week has been pretty interesting. JP Morgan this week down by something like 6%. Then you've got the likes of Goldman up by around about 4%. Two very different stories. What gives? Plenty of explanations. Here's one. One has got exposure to credit cards and the president's going after them, and the other one does not at all.
It was all about policies out of Washington, even for the banks that did so well. Some of that trading has to do with volatility, getting deals over the finish line, has to do with deregulatory push, how a lot of people were on the sidelines during the Biden administration and were so excited for Trump to come in for M&A and IPOs. But if you have a credit card, now you have a target on your back from this administration. The president is not backing down. Who knows what we get? Potentially some sort of swipe fee competition bill gets through, maybe a cap, not as high as 10%, according to people I'm thinking of. But if you have a credit card, this is now a risk for this year before the midterm elections in November.
This is the populist spark into the midterms. Let's see what the bite actually looks like. It's not just the financials, it's tech as well. We open up the program by talking about energy, and it's not just the president going after these names. Governor Kathy Hochul here in New York doing almost exactly the same thing, pushing for the energy companies to either generate their own electricity or pay more for the stuff they're taking from the grid.
Basically, what the president is saying is you tech companies need to either become utility companies or subsidize the U.S. consumer because these rates are too high. And we saw this story play out in Virginia and New Jersey when it came to those governor races. Individuals that were talking about the electricity prices are too high, those individuals did very well at the polls. This is interesting because the president is not just going to be flanked by Governor Glenn Youngkin, a Republican in Virginia, which has a lot of data centers. Josh Shapiro of Pennsylvania will also be there at the White House. You see this olive branch to the left, to the Democrats, from this president. And you know what, Jonathan? A lot of these issues should be dealt with on a state level. Trump is taking it to the federal level.
We're going to see more of this in the year to come, no doubt. In fact, the years to come. If you are just joining us, welcome to the program. Equity futures this morning positive by about 1/3 on the S&P 500. Coming up this hour, we'll catch up with Eric Friedman of Northern Trust with stocks near record highs. Dana Peterson of the Conference Board on the issues keeping C-suites up at night. And Erica Najarian of UBS wrapping up big bank earnings on Wall Street. We begin this hour with stocks rising on a fresh round of momentum across the equity market. Eric Friedman of Northern Trust writing, we remain constructive on traditionally riskier asset classes. We expect stocks to continue to outperform bonds. Eric joins us now for more. Eric, 1, congratulations on the new seat. 2, welcome to the program. And 3, the first question, sir. It's good to see you. Let's just get into it. What underpins that view that's pushing stocks to outperform, say, bonds?
Jonathan, congratulations to you as well. I think first and foremost, we still think that this notion of consensus being still too bearish on growth and probably too overzealous on inflation, a theme that we talked about throughout 2025, we think continues. And Anne-Marie, I think, nailed it with some of her comments about the banks that we've heard from thus far. I think, number one, consumers at the margin are not outperforming massively, but they're really hanging in there. We've seen a very promotional environment. We've seen a lot of discounting, but that being said, consumers are still very involved in terms of day-to-day purchases. Also, corporations, not just in the U.S., but globally, they've really recalibrated, Jonathan, in terms of thinking about trades and tariffs and what may happen headline by headline. In general, that recalibration, I think your colleague Tom Keene would say the adjustment process is really fully underway. So those are still two tailwinds until we're proven wrong. Again, we have to respect the fact that we pulled forward so much in terms of earnings, so much in terms of returns, that we don't think this year will necessarily be a continuation of the last 3, but still incrementally positive on stocks over bonds.
It is a midterm year. Eric, I was going through your note, an interesting read, and you said this. In a midterm election year, it keeps the risk-on bias intact. Is there something different about this populist twist that might upset the traditional story?
I think the biggest risk, Jonathan, is that the Fed loses the 10-year. And when I say that, I think, you've all done a great job of reporting on the various policy sets that may come forth. There's certainly a shift in voters' minds about what really their priorities are, and a lot of it focuses on the economy and inflation. And one of the things that we obviously enjoy about our line of work is that markets don't really care about narratives. They care about perceived policy impacts to things like getting paid back. So there have been a couple instances in history, not to go back to history books, where the Fed has lost a 10-year. And for us, that would signify a 10-year, north of 4.75 or 5. Pretty far from where we are right now, but that could probably upset the narrative, if you will, Jonathan, that, all these policies have to be ultimately paid for. For a long time, the bond market has kind of shrugged them off, but in aggregate, if there's too much, we think that risk of the 4.75 to 5% 10-year yield challenge, that could be something that becomes more front and center.
You might be giving the Treasury Secretary a heart attack this morning, Eric. What kind of policies exactly from Washington could put the 10-year yield north of 4.5%?
I think the biggest, Anne-Marie, would be an overextension of let's call it tax, or perhaps more episodic stimulus that eventually just aggregates to a point. Everything from a lot of the considerations around tips, taxes on tips, or even some, let's call it state level stimulus, if you will, that pops in. I do think that ultimately, and again, we have this IEPA ruling hanging over our heads. That outcome is obviously an uncertain one, but if we do have some concerns from the bond market about pay-fors, as well as an increased level of stimulus coming through that is not fully paid for, those are items that eventually, let's call it the St. Bernard that is the market, that lots of things tug on its fur, may say, okay, we've had enough. we're going to test the resolve of this administration. That's where investors could get concerned. That 4.5, 475 level becomes much more relevant.
A lot of guests had come on this program and said, look through the Supreme Court, because even if they do strike down IEEPA, the president is going to use other legal justifications for his tariffs. Do you think that it really is a market-moving event?
You know, Anne-Marie, you individually have done a great job, almost encyclopedic, about the other sections that the administration could use. Where there's a will, there's a way. That's our thought process. We're obviously not trade experts day to day or trade law experts, but there is a clear bias from this administration. Everything from sharing a CPI report and other factors with quoting the tariff regime as being at least a causal agent in helping things out. So where there is a will, there is a way. So we do think that, again, the reaction would probably just be that, a reaction. But again, our thought is that the tariff regime will continue, probably just under some different section of the law.
Eric, the stock market's moved on, as you well know. The equal weight S&P 500, all-time highs, 6 days of gains. The Russell, we talked about at the top of the hour, outperformed the S&P for 10 consecutive sessions. Eric, a lot of people have been waiting for this, and they see these moments where you get these rotations, but they don't last too long. Has something changed?
Yeah, Jonathan, we do think something has changed. I think that the broadening out trade has been very well documented. I mean, the way that we're playing this is that we really don't want to be underweight tech. We really don't want to be underweight some of those picks and shovel companies that we've all talked about for some time. And again, part of our overweight stance towards equities is that we want to have at least equal weight exposure to tech and infrastructure, and then a little bit of the other things that haven't really caught up. Again, I think the pull forward, though, of returns, just the things we've been talking to our clients about, is that, look, we've compounded in the S&P over the last 3 years at 23%, EFA 18%, EM 17%. Those are big numbers. So that pull forward is something we have to respect. We do think the broadening out is a good thing, but again, have a little more subdued expectations for returns for this year. That's probably the right posturing to think about as we turn the page.
Eric, can we just sit on smalls just for a moment? Initially, when this trade ignited, it was about rates. The rate cut story has really stalled now. Rates themselves have stabilized. What's it about now?
Yeah, I think it's about a catch-up, Jonathan. I mean, a couple of things about the Russell Index. You think about the quality factor, about 25% of the Russell 2000 does actually not have profits. So, there is a bit of a momentum, called lower quality bias there. Also, there's a large bias towards financials, which people don't really think about, and obviously financial related entities. And one of the things to keep in mind is that the 10-year to Fed funds spread is actually at its widest it's been in about a year. It's kind of in line with where it's been over the last 5 years, but over the more recent time period, that steepening, if you will, between Fed funds and the 10-year, that does bode well for that set, and certainly has been a tailwind for the Russell 2000.
The 10-year this morning, 417. Eric, good to see you, sir. Eric Friedman there of Northern Trust. Thank you for joining us. Small caps so far this year, a couple of weeks into a new year. The Russell is up by close to 8%. To be precise, up by 7.76% so far in 2026. That is quite a run. That's the stock market. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Good morning. President Trump and the governors of several northeastern states agreeing to push for an emergency wholesale electricity auction that would compel technology companies to effectively fund new power plants. The plan, set to be announced this morning, seeks to address how the nation can supply electricity to data centers without hiking utility bills for homes and businesses. Iran averting a U.S. strike by pledging not to execute protesters. In a post on Truth Social, President Donald Trump writing, Iran's decision not to sentence protesters to death is good news. Iran's judiciary on Wednesday ruled out a death sentence for a 26-year-old activist who it said was at risk of imminent execution. The U.S. and Taiwan agreeing to a trade pact that would lower tariffs on goods from the island to 15%. In return, Taiwanese semiconductor companies will increase financing for their American operations by $500 billion. That includes at least $250 billion in direct investments to expand semiconductor, energy, and AI facilities. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie later on this hour. Up next on the program, pushing big tech to pick up the tab.
Every company will be given the right to build their own power plant. We'll use every tool at our disposal to ensure that the United States can build and maintain the largest, most powerful, and most advanced AI infrastructure anywhere on the planet.
That conversation up next with John Lieber of Eurasia Group, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Things are a little quieter stateside going into the long weekend. Things might get noisy next week. Check it out. The President, Wednesday. This is the main event next week and could well be market moving given the experience of the year so far. The President addressing the World Economic Forum on Wednesday morning.
So if you are one of these individuals that he thinks you're a globalist elite, you potentially might get called out when the president gives his speech at the World Economic Forum. But we also know that in this push for affordability he's had domestically, he's going to talk about that on this stage in front of everyone around the world. Caroline Levitt talking about how he wants to talk about housing while he's there. So whatever his message is internationally, there will be some thread back to the U.S.
This year so far, defense sector, whipsawed. Home builders, you mentioned them, whipsawed. Credit card issuers, whipsawed. What's in store on Wednesday? What are the sectors? The tech players, energy? I don't know at this point.
Well, the tech sector has already been whipsawed in a sense. We've already heard from Microsoft saying we are going to make sure that we are putting up more of the money for the electricity. And Gil Luria is quoted as saying this might actually start to hit some of the tech players' margins because the president is basically asking, the crux of this is, you have to subsidize American consumers' electricity bills.
That's the story for next week. This morning, equity futures still just about positive, up by 1/3 on the S&P 500. On the Nasdaq, up by 0.6. The big winner of the year so far, the Russell. Small caps higher by 0.4%. Under surveillance this morning, pushing big tech to pick up the tab.
Every company will be given the right to build their own power plant. So when you build, you can build your power plant with it. And you are essentially going to become your own utility. Any excess energy you're going to sell back to the grid and make plenty of money doing it. We'll use every tool at our disposal to ensure that the United States can build and maintain the largest, most powerful, and most advanced AI infrastructure anywhere on the planet.
So here's the latest this morning. President Trump pushing for tech companies to foot the bill for new plants to power AI data centers. Sources telling us here at Bloomberg the move would fund some $15 billion of new plants to take pressure off of homes and businesses. Joining us now from Washington is Bloomberg's Tyler Kendall. Tyler, the big push, the latest big push of the last 24 hours.
Yeah, hey, John, good morning. I mean, this is considered to be an unprecedented move aimed at easing concerns that data centers are driving up electricity costs amid the AI boom and the fact that this White House is playing defense when it comes to affordability. Now, a White House official tells Bloomberg News that President Trump, alongside a number of governors whose states are served by the nation's largest power grid, PJM, will call for an emergency wholesale energy auction where essentially big tech companies would place bids to fund new power plants. And we are talking about, just for context here, unique and one-time terms. Typically, PJM holds electricity auctions for a 12-month period, but instead, this plan is putting forth the idea of 15-year contracts where the only bidders are data center owners and operators. Now, this grid in particular, which serves 13 states, has been strained by more data centers coming online and actually more power plants going offline faster than they can be replaced, which has put a squeeze on supplies. And as you heard there, President Trump has previously floated this idea that he likes that data centers could be built alongside power plants. And we sort of heard him tease that this announcement was going to be coming earlier this week when he took to Truth Social. And he said that he was working to ensure that big tech doesn't drive up prices and praised, as Anne-Marie mentioned at the top of the segment, a pledge by Microsoft to pay more of its, quote, fair share. Now, our reporting indicates that this is going to be a non-binding directive, which means that PJM doesn't necessarily need to go along with it, so it might not come to fruition, though there is definitely mounting pressure. John, expected at the White House today is Democratic Governor of Pennsylvania, Josh Shapiro. I actually sat down with him back in September, and at the time, he told me he was threatening to pull his state out of PJM if the grid operator didn't do more to rein in costs. I would expect some similar threats could be on the table today.
Tyler Kendall with the latest down in Washington. Tyler, thank you. To extend the conversation, John Lieber of Eurasia Group joins us now. John, you heard it there from Tyler. Anne-Marie mentioned it as well. Governor Shapiro at the White House. Is this just the new political reality that both parties have to confront?
Yeah, I mean, I think actually President Trump's trying to get out ahead of the curve here. We know affordability is probably the #1 issue on voters' minds for 2026. And this electricity issue was a factor in some of the off-cycle elections that we saw in New Jersey and Virginia last year. So, you know, the data centers, it's a big deal. It's a big part of Trump's industrial strategy. They want the U.S. to be the world leader in AI. And to be the world leader in AI, you need to consume a lot of energy. And that's going to become an increasing political problem for people all over the country. I do think, to your point, it's notable that Democrats are willing to play ball here with the administration. This reflects the power that only the White House has. And I think that this is going to be an ongoing theme that we see throughout the year.
Not just Democratic governors willing to play ball, tech companies, Microsoft, Brad Smith, we're going to ask utilities and public commissions to set our rates high enough to cover electricity costs for our data centers. John, is this just another implementation of state capitalism?
Yeah, I think that's exactly one way to think about it. I think Microsoft knows that the Trump administration is their biggest champion. They really need Trump to get the licenses that they need to have access to semiconductors. I mean, the administration has been extraordinarily aggressive shaping how these tech companies sell chips, buy chips, have access around the globe, and they've been championing them. And I think that Microsoft sees the writing on the wall here, which is that this is a growing political story that they need to get ahead of, exactly the same as how the Trump administration's doing this. And I think this, again, this is going to be a big theme for the year. I think that electricity is a vulnerability for the president. And by doing this and by getting their partners like Microsoft to do this, it's an incredibly savvy way of saying he's doing something about the problem.
Not to get too in the weeds, but there is a law from 1935, the Federal Power Act, which basically separates, when it comes to the grid, how the state's jurisdictions over it over the federal government. Are we pretty much just resetting new rules of engagement between how the states deal with electricity?
You know, I'm not familiar with the rules of the electrical grid and how it works at the state level, but I do think federal intervention here is probably appropriate. And given that this is multiple states coming together to drive this new initiative and put this new electricity on the market, and it's affecting all these tech companies that are trying to invest everywhere in the United States, this sets a tone for the entire country and tells these tech companies that they're going to need to be partners in solving this problem. And because of that, you're probably going to see more efforts to take advantage of a diverse source of electricity generation, including probably over time nuclear power, which had previously fallen out of favor in the United States. And now that the tech companies need it, is going to be surging back.
John mentioned all what's going on in terms of the president's latest salvos on Truth Social, the defense sector, housing, credit card companies. What do you expect him to deliver at Davos?
Yeah, it's only been, we're in the third week of the year, and it feels like we've lived 3 years so far, given all the stuff that's going on. Yeah, I think the Davos speech will probably be a chance for Trump, as he does, to air some grievances in front of a crowd that he probably thinks is hostile to him, but he still wants to get in front of. He mentioned housing as one of the things he's going to talk about. I think there's going to be other affordability things brought up. One of the big things on housing is long-term rates. They've been attempting to use Fannie and Freddie in order to get long-term mortgage rates down. I think that probably healthcare is going to be an issue that is in focus in this speech on affordability. There's still the live issue of these Affordable Care Act subsidies that's happening in Congress right now. And then electricity, I think, and energy costs are probably going to be a big piece of it. Not just electricity, but also energy prices. I mean, oil prices. That's one of the primary drivers, or at least it's the primary outcome of this Venezuela interdiction, is that they're putting all these new barrels of oil on the market. And I think that keeping energy costs low is going to be a big theme.
John, is there a home for people who support traditional conservative policy?
In the United States, I mean, no. You've got the Republican Party is, or at least under Trump, is massively interventionist, and there are a lot of Republicans, many of whom have only been elected in the Trump era. I mean, over the half of the House of Representatives came into office after Trump was already here, and have helped him totally reshape this party into a much more populist, much more aggressive, much more interventionist party that seems to have no limits to the kind of things that they're going to do to deliver benefits for voters. So I think the era of small government is really over here, and you're going to see a government that's on both sides that's now reacting to the need for voters to want to see change in their life. And so I think both parties now are going to be much, much more aggressive in how they try to do that.
How much daylight do you think there'll be between the two parties on economic policy by the time we get to 28?
Very little. Probably tax policy will be the big one. There will probably be more lip service paid to the deficit from the Republicans. Democrats will probably support a more larger tax increases in order to bring down the deficit. I think on trade, you're going to see a lot of similarities. Labor policy is probably another one where you see a big difference, but more divergence in the coming years. So, I think the parties are going to compete on cultural differences. Immigration will probably be a big wedge issue in the upcoming election. But on economic policy, these parties are looking more and more similar to each other.
John, appreciate it. John Lieber, the Asia Group. Thank you, sir. Notice this on the campaign trail. Do you remember the president would come up with an idea on the campaign trail, and then Kamala Harris would come out with it the next day? Do you remember? It was like that, and now you see the same thing this time around.
And people didn't think no tax on tips could get through. So those individuals, I'm reminding them that actually did happen when you're concerned about the credit card interest rate caps. It might not be exactly. Remember, the president, Jonathan, you remind us all the time, anchors the debate to the extreme. So maybe it's not going to be 10%, but if he says something, he's going to push for it. So expect more of this as we head into November and then 2028. My mind hasn't even gotten there yet.
Stock market's looking right through it. Earnings are good. Equities are up. We're up by another third of 1% this morning on the S&P 500. Up next, we'll talk about CEO confidence with Dana Peterson of the Conference Board.
crises, two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Live from New York City, welcome to the program. A cold start to this Friday morning, going into the long weekend here in New York City. Very, very cold. Equity futures right now in the S&P 500 positive. Warming up, we're up by 1/3 of 1%. On the Nasdaq, up by 0.6. Struggling to put together back-to-back weekly gains on the S&P. Let's see if we can change that later on this morning. It has not been a struggle for the equal weight. The equal weight S&P 500 positive for 6 consecutive days and 10 straight sessions of Russell outperformance versus the S&P 500. Jim Reed of Deutsche Bank pointing out we haven't seen that since 1990. Russell futures up by 0.4%. Turn to the bond market. What a snooze. A welcome snooze for the Treasury Secretary. This is what they want to see. Stability in the bond market is what we've got. 417.15 on a 10-year. Last Friday, we closed at 416. And since this morning, we're again at 417. That's the story of the bond market.
But Eric Friedman's talking about potential risks this year and going into the midterm elections, too much of fiscal impulse. You have the bond market really pushed back, especially also what if the IEEPA tariffs are deemed illegal? The bond market has looked at that and said, look, we're maybe able to potentially bring the deficit down with more money coming in. That would not bode well for this administration.
Dead flat treasuries, front end, long end, really sleepy stuff through the week so far. Turn to foreign exchange. This is a quiet rally. The dollar index, DXY, and this is euro dollar showing a bit of euro strength, but DXY quietly putting together 3 consecutive weeks of strength. And if we do that, we close this Friday for another week of strength. That's the longest run going back to May of last year, so there you go. Bit of dollar weakness this morning, euro positive to 116.19. As we count you down to the opening bell, let's get you some morning movers, some single names. Let's cross over to Danny for more. Hey, Danny.
John, I'm going to show you where the real strength is in this market, and it is memory chip stocks. These things continue to fly. Look at the pre-market session for SanDisk and Micron. Those shares are up at least 5.5%. SanDisk this year is up something like 70%. Micron not as impressive, but still in the high teens. No specific news, but it's the continued momentum underscored by TSMC yesterday that there is so much demand for AI, and that is translating into demand for memory. But there's a bad side to that. It is for any of the hardware providers, hardware makers that also need memory chips. HP is one of them. They received a downgrade this morning from CFRA saying, 1, the company has very anemic growth, and 2, its costs are going to start soaring because of what's happening in memory chips. Those shares are down 2.6%. Rounding things out this morning with some earnings, we got the trucker company JB Hunt reporting yesterday. It was a miss across the board. It is continued weakness for the freight industry. For one, they have an oversupply and not enough demand. And you saw in JB Hunt's earnings that transcontinental shipping, it is down massively. Basically, the only growth they saw was within the United States, within the U.S. East. So those shares falling 5.4% in the pre-market, John.
Danny, thanks for the update. Appreciate it. More from Danny in the next hour. On our radar this morning, President Donald Trump pushing tech giants to foot the bill for new power plants. Sources telling us here at Bloomberg the plan will require companies to sign 15-year contracts for electricity, whether they use the energy or not. Elsewhere, the US and Taiwan reaching a trade pact, slashing tariffs on Taiwanese goods to 15%. In exchange, Taiwan investing $500 billion into American semiconductor manufacturing and financing guarantees. And your final story, a controversial one. Ford reportedly in talks with China's BYD about supplying batteries for hybrid vehicles at its overseas factories. Sources telling us here at Bloomberg those hybrids would be exported worldwide, a move that's already sparking political backlash in D.C.
From the White House, from Peter Navarro, he was quick on X to talk about, saying Ford wants to simultaneously prop up a Chinese competitor supply chain and make it more vulnerable to that same supply chain extortion. What could go wrong here? Those are the words from Peter Navarro. Ford is looking at this like, look, we already use BYD batteries when it comes to our vehicles in China. And I remember the commodity guys years ago said to me, you're too focused, Anne-Marie, on the raw materials. Think about what China's long-term play is. They are the only ones that have the raw materials and the processing power, 80–90% of the market, to actually make that battery. At some point, China is going to say, you want electric vehicles? Buy our cars. That's the entire long-term play. And you can see Beijing being absolutely propped up by this, and this could be the baby steps going towards that direction.
There's a big negotiation coming up, USMCA. And I wonder, Anne-Marie, the direction of travel here, because really when you think about USMCA, the industry most exposed to that, just one, auto manufacturers, Ford, GM, Stellantis. It's going to be a big feature of the conversation through the next year.
Especially as the Prime Minister of Canada, Mark Carney, this morning posts a photo on Twitter of him and Xi Jinping, talks about this new strategic partnership.
New world order.
With China.
To use the Prime Minister's exact, precise language.
Yeah, and a new strategic partnership when it comes to trade and other things when it comes to China. Do you see countries that are close to the United States that should be working more interlinked with the United States actually looking to maybe go to China because it's cheaper products, and right now the rhetoric coming out of Washington isn't helpful for them?
Ford this morning in the pre-market, positive by 0.1%. Let's turn back to markets. Earnings season off to a strong start as investors position for the year ahead. Dana Peterson and the team at the conference board releasing their 2026 C-suite survey, identifying the top issues keeping CEOs up at night. Dana joins us now for more. Dana, welcome to the program. Share what you found. Number one last year had to have been tariffs, so we moved on from that pretty quickly. Is it still tariffs, or have things changed?
The new word is uncertainty. Businesses are just not sure, certainly about tariffs, but also geopolitics, regulation, and many of them see AI as a very disruptive force, either for good or for bad. And so with all those things, CEOs are just very worried, and they are trying to figure out ways to kind of cut through the fog so that they can remain profitable.
Dana, by definition, the future is always uncertain. What is unique about this? And are they experiencing a form of paralysis, or are they actually making decisions and moving forward?
Well, if you go back to 2024, there was a lot of excitement. Businesses were anticipating deregulation. They were anticipating lower taxes in the U.S. However, all of last year was just really wild in terms of changes in policy. Though you did have tax cuts and also acceleration of depreciation for writing that off, you also had rescissions in industrial policies, and many industries are very much dependent on that, especially those who are looking to onshore, and now that money is gone. And so coming into this year, you have this kind of doubling down in geopolitical issues, not only linked to trade, but also linked to energy. And as mentioned earlier, affordability is a huge issue for many consumers in the U.S., and also businesses want certainty. And so we are seeing businesses just kind of stuck, waiting around to see where things fall. And that certainly is a drag on the economy.
So what do they do with this information, Dana? This is how they feel. They're concerned about geopolitics, governance, market dynamics. If you're a corporate executive, how do you weather 2026?
Well, the big theme is business plan changes. That could mean small tweaks, just kind of editing things, or it could just mean ripping up the old plan and just starting anew. And many companies are realizing that they need to pivot. There are these major structural and social geopolitical changes that they have to wade through. And they see sitting down and making sure their financials are sound, their governance and risk apparatuses are sound, but also that they're investing in their people. They're investing in their operations. They're investing in new areas. Very much investing in customer service. And they also see AI and training their people as key elements of this transformation.
Do they also think that AI not just could train their people, but also mean that they could reduce their workforce?
Well, I think it really depends on the industry. So certainly the tech sector is looking at AI as a form of automation and also cost savings by having fewer people doing things that computers can do. But there are many other sectors that actually need human beings, like healthcare, construction. And so I think it's, for many businesses, it's, okay, how do we use AI to, facilitate productivity and growth? But you still have that people element. And indeed, CEOs are looking very much to invest in their own people to make sure that they are ready to deploy AI.
Dana, just to build on that, when you look at C-suite confidence, how does it compare to, say, consumer confidence?
Well, consumer confidence, according to our measure, has been slipping over the last year. Consumers are not very pleased with the current situation. Certainly, prices are still elevated. They're still very uncertain about what's going to happen. They're worried about future job prospects as well as their own incomes and finances. So all of those things are very disconcerting for consumers. The key is, does that show up in spending? And we do see that consumers are spending more on necessary goods and services like food, utilities, housing. And even if they want to go out and have fun, they're streaming instead of going to the movies, which is much more expensive. So consumers still are spending. They're just shifting their priorities in terms of what they are buying.
Dana, always appreciate catching up with you. Thanks for sharing the study with us. Dana Peterson there at the conference board on consumer confidence and C-suite confidence into 26.
How she ended there and what consumers are having to shift some of their priorities, spending more on food, spending more maybe streaming because you can't afford to go out to the movie theater. I wonder if the White House read this report as well, because they're also going after things like she mentioned, utilities. This is all in the playbook of these populist rhetoric and these populist ideas we've heard from this administration, especially ahead of November, because this is what consumers care about.
They don't need to read this. They just need to look at the polls, and you can see it pretty clearly into the midterms. Equity futures on the S&P positive by 1/3%. With an update on stories worldwide with your Bloomberg Brief, let's cross over to Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. President Trump accepting Venezuelan opposition leader Maria Corina Machado's Nobel Peace Prize medal, saying in a post on Truth Social, "It's a great honor." Machado says she handed it to Trump during their White House meeting as a recognition of his unique commitment to Venezuela's freedom. JP Morgan CEO Jamie Dimon saying there's, quote, absolutely positively no chance he would take the Fed chair job. Speaking to Carlyle's David Rubenstein, Dimon saying he would take the call if considered for Treasury Secretary. Dimon also expressing concerns that chipping away at Fed independence could lead to higher inflation and interest rates over time. TSMC shares trading higher in the pre-market after hitting a record yesterday, following its report of a huge fourth quarter profit. CFO Wendell Huang speaking to Bloomberg about the company's future.
In the next 3 years, the total capex is going to be significantly higher than the number in the past 3 years. So that is evidence of our strong conviction in the AI megatrend.
Wendell also saying TSMC will try to accelerate the transfer of its advanced chip-making expertise to the U.S. in the future. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next on the program, big banks setting a high bar.
Their valuations today are very rich. So the high bar that's out there, they met it, but they didn't greatly exceed it like they were doing all of last year.
A conversation up next with Erica Najarian of UBS, live from New York City. You're watching Bloomberg TV.
this is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a little ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now that these 2 fingers, top to the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is 1 to 6.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity futures this morning, positive by 0.25% on the S&P 500, looking to secure another weekly gain on the S&P 500, just short of that as things stand at the close on Thursday. Short of nothing right now on the equal weight. The S&P 500 equal weight at all-time highs at the close on Thursday. 6-day winning streak. The broadening gap continues. The Russell, the small caps, keeps rallying and outperforming the S&P 500 for 10 straight days. The Russell this morning up by a third of 1%. In the bond market, really sleepy. We've talked about that as a feature of the year so far. The 2-year in the 350s to end this week like it was just last week, 350, 650 at the front end at the moment. And just a chorus of Fed officials over the last week basically saying the same thing. Policy's in a good place. That was Mary Daly. Raphael Bostic saying inflation's too high. Goolsbee saying something similar. Got to get it back to 2%. You were in the room with John Williams, the New York Fed president. Monetary policy is well positioned.
No urgency to move one way or the other. No urgency for cuts. Look, they just came on the heels of 3 meetings where they cut interest rates. And right now, the data isn't flashing a warning that they should be cutting even more. I think that unemployment rate, that's when JP Morgan decided to change their view. 4.4% on the unemployment rate. Nothing scary right now. So what they're calling for is no rate cuts for 2026 and a hike in 2027.
The data's pretty decent. The earnings are too. Under Savannah's this morning, big banks setting a high bar.
We think the play for 2026 is financial, so we're still there. You look at the actual numbers at the end of 2025, the upgrade or the increases in estimates were driven by investment banking, trading. The stocks have had a very good year in 2025, and their valuations today are very rich. So the high bar that's out there, they met it, but they didn't greatly exceed it like they were doing all of last year.
So here's the latest this morning. Wall Street's biggest banks reporting a record $134 billion in trading revenue and a major upswing in deal breaking to start the year. Joining us now is Erica Najarian of UBS. Erica, welcome to the program. Strong momentum to close out last year into this year, but a real performance gap opening up this week between the likes of a JP Morgan down and a Goldman Sachs up. Erica, what explains that?
So I think it's pretty simple, right? Valuation aside, what the market is telling us is really that they care more about the pure play exposure to capital markets than they do about valuation. Because if you look at the likes of Morgan Stanley and Goldman Sachs, on an earnings basis, they're not cheaper at all relative to the big money centers like JP Morgan. However, it's a little bit more of a straightforward story rather than the money centers where you have to grapple with, interest income trends relative to the curve. You have to grapple with the credit card rate cap headlines. And so what the market is saying is, wow, we just heard David Solomon say that advisory revenues in 2026 could be better than 2021 in the base case. So why not own cap markets? And by the way, given Morgan Stanley's results, why not own wealth stocks?
Erica, do you think that's the play for 26, those trends to continue?
Look, I think if you already own Goldman, Morgan, and the money center banks, why would you sell them? The momentum is still there in terms of EPS revisions. But what we've been saying is, as we think about new money investments in banks, look, it's going to be a little bit of a tougher climb. So think about what the next sort of leg is in terms of EPS revisions. It might be more like Main Street rather than Wall Street. Small to medium sized enterprises finally expanding. And what I would say is I would look to the regional banks. Additionally, given some of the rate cap headlines, we would also look into some of these beat up consumer finance names that probably didn't deserve to be as beat up as they've been, like Capital One, for example.
Erica, can we talk about the credit card cap interest rate, the probability you and your team think of that, or maybe the competition bill getting through Congress?
Yeah, absolutely. We think it's low probability, extreme outcome, right? And I think that's how the market sort of priced it in on the Monday, the first trading day after that social media post from the president. Look, I mean, you guys, I know, I'm sure you guys pay off your bills every month. Look at the back of your card. Your APR is nowhere close to 10%, right? And so when you do a 10% cap, even if it's just for a year, of course it's going to impact lower income Americans, but it's also going to impact sort of the middle, right? Think about sort of someone that's making $100,000 and is a prime, customer, but the economics just don't work at a 10% rate. And so I think that especially in a year where, consumer strength, affordability is the buzzword, taking away liquidity line from the U.S. consumer is not the move ahead of midterms.
If we were to see some action, though, when it comes to this in Washington, who out of the big banks is best to weather that storm?
I mean, it's always the same answer, right? JP Morgan, even though they're even though they're huge in card, if you run the numbers, they're huge in everything else, and they're so good at everything else, and it's like, it doesn't impact them as much.
Even if the CEO keeps talking.
What's that?
Even if the CEO keeps talking, meddling in Washington.
Look, Jamie's gonna Jamie, right? And he's seen as the leader of the industry and a spokesperson for the industry. So, if he needs to agitate a little, I think that's what the industry needs in terms of, a mouthpiece and a representative of the industry. But look, at the end of the day, it might be, a nick to JP Morgan's earnings, but, having such action would be an extreme impact to the U.S. consumer.
Erica, why do we always walk away from earnings season with JP Morgan talking about Jamie Dimon and not the results themselves? Is there anything in the results that stood out for you?
Look, yeah, of course. Look, I think the reason JP Morgan was off the day it reported is that, investors were used to be, huge, like a big beat and a big raise kind of number. And they kind of previewed what they were expecting for 2026 in October and December of 2025. So there's no really big surprises. And at that valuation, everybody sort of expects JP Morgan to, continue to leap over the high bar they set for themselves. But look, at the end of the day, I think the story is the same for JP Morgan. They lay out a target. The macro environment is pretty, conducive for earning a lot of money, and they're going to leap over it, right? So I think particularly in January, and particularly given the volatility in geopolitics and local and national policy, we did need to hear from Jamie. And that's why Jonathan and Anne-Marie, what he says sometimes is even more important than what the numbers say.
True, I give you that. I just get frustrated sometimes. Not with you, Erica, of course, just with the general media environment that it's always about Jamie and whatever he's got to say on any given issue, and it's never about the results themselves, Anne-Marie.
And it's about issues that actually he doesn't have sometimes serious portfolio on, it's always about like, well, what do you think of Ukraine? You know, and it's something.
Tell me about foreign policy.
Right, and they just came out with these numbers, and people want to know about China or Kyiv from him.
Erica, as you say, though, there is this faith in their ability at JP Morgan to hop over the hurdle, to ultimately whatever they put up, they'll beat. Do you have that same faith in Bank of America off the back of the Investor Day delivered at the end of last year? Do you have that same faith?
No. Look, I think the valuation is definitely unchallenging at Bank of America. And, you know, the engine is there. But, you know, there is a reason why, you know, sell-side analysts like me get attracted to that devaluation, and then the market gets a little bit, you know, disappointed. It's just they don't execute as well as JP Morgan. And so, you know, at the end of the day, I think, you know, the company really needs to take advantage of the first quarter, you know, conference season and smooth out and be very clear about the messages that they meant to convey during Investor Day, which is that they're poised to grow revenue and they're going to, you know, make sure that falls mostly to the bottom line, and they're going to control expenses relative to the revenue opportunity. I think the issue here is sort of the opposite of JP Morgan sometimes, in that, you know, the communication is perhaps not as precise, it's not as clear, and the investor base gets frustrated. So, you know, it's almost the opposite, right? If you just look at the numbers and don't listen to the call, you might actually come away with a better conclusion on how the stock trades, right? Whereas everybody, to Anne-Marie's point, like listens to the JP Morgan call and just ignores the press release and the supplement. And so, you know, I think Bank of America has, you know, big shoes to fill if it wants to be anywhere near close to its closest peer, JP Morgan.
Erica, appreciate your take as always. Thanks for joining us today. Erica Najarian there of UBS on the likes of JP Morgan and Bank of America. The winner of the week, though, Morgan Stanley, Goldman Sachs. Goldman Sachs positive for 8 consecutive weeks. The rally continues.
They had unbelievable numbers when it comes to Goldman Sachs. Some of these fees, when it comes to deal making, when it comes to the equities trading division, and Goldman Sachs and Morgan Stanley. And I hear Erica. She thinks that JP Morgan, even if something was done with the credit cards, would be the best to withstand the storm. But Morgan Stanley and Goldman Sachs actually are more insulated from that story if that legislation were to pass down in Washington.
Equity futures this morning rolling over just a touch. We're still positive by 0.2%. In the next hour, we'll catch up with Stephen Parker of JP Morgan Private Bank, Clayton Siegel of CSIS, Jill Carey Hall of Bank of America, and Vishal Kanduja of Morgan Stanley Investment Management. The second hour of Bloomberg Surveillance, just around the corner.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the U.S. or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
The economy overall doing strong.
If you look at the underlying trends in the U.S. right now, you're not seeing much inflationary pressure.
I am still concerned that this is a labor market that is gradually weakening.
We have a pretty good sense of where the economy is heading.
We're about to see growth inflecting higher.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
When I first moved here, I used to say, why do you need a holiday this early in the year? Just had Christmas and New Year. Why do you need a holiday? 2 weeks into 26, I need a week. Never mind a long weekend.
You got to recover, whether it's from the holidays or just from the onslaught of policies coming out of Washington. What was it, just only a week and a half ago? Was the capturing of Maduro?
Yeah, that feels like a lifetime ago.
A decade.
A decade ago. Live from New York City this morning. Good morning to you all. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures on the S&P 500 up by 1/10%. The Nasdaq up by 0.5. What a run for the Russell. Up so far this year by close to 8%. Up again this morning by 0.2%. Long weekend coming up. Looking ahead to next week. The big one's on Wednesday. The President of the United States, Donald Trump, addressing the World Economic Forum in Davos, Switzerland.
So this is the White House thinking that the World Economic Forum is filled with a lot of globalist, elitist individuals, and yet the president is going to come there, probably going to go after a few individuals in the audience that don't always acquiesce to him or don't always line up on his policies, but he's going to have a message for Americans back home, because we know that he's going to talk about housing. Today in the Oval Office, he's going to talk about the fact that electricity prices are too high for consumers, so the tech companies need to subsidize those electricity prices. And we know that potentially he's going to talk about geopolitics and defense, and the fact that the administration wants to see the defense sector really shore up more in the United States and not give money back to shareholders.
This is not just a Republican position, it's a Democrat position as well. The first thing you pointed out earlier on this morning is he'll be alongside the Democratic governor, Josh Shapiro of Pennsylvania.
Of a swing state, an individual that might be running for the presidency of 2028. So he's not just lining up with, I could see him lining up with Glenn Youngkin, especially given the fact that there's a huge concentration of data centers in Virginia. But he's going to be joined by Josh Shapiro. Josh Shapiro was almost the vice presidential candidate to Kamala Harris. So we have seen the president really go across the line when it comes to wanting to work with Democrats because the policies are populist. In this week alone, he's not just standing next to Josh Shapiro, he called Elizabeth Warren. He is texting with Zohran Mamdani, a Democratic socialist in New York. You have to think, is he calling French Hill? Is he calling individuals that are more the conservative wing when it comes to fiscal conservatives in Congress? I don't think so.
Corporate America has got to be worried when you look down to Washington and realize this is not just a single party issue. This is a bipartisan push now. that's going to cross tech, home builders, defense companies, the lot. We've gone after so many different things. Corporate pay, stock buybacks, investing in single-family homes. The list is getting longer and longer, and it's only January 16th.
And taking outright equity stakes in some of these companies. These are policies that individuals like Bernie Sanders would run on. Bernie Sanders literally wrote the bill for a 10% interest rate cap with Josh Hawley. And that got introduced last year. So these are policies that, you're right, if you're the C-suite, they're not going anywhere anytime soon. And you brought up a great point. I'm so focused on the midterm election because that's this year, that's here and now. That's my everyday. 2028, what policies are going to be different? Maybe just some social policies.
Yeah, and they're the most divisive ones at the moment for sure. And if we turn the volume up on those into 28, it's going to be an interesting 2 years ahead of us. Equity futures right now in the S&P 500 positive by 0.2%. Coming up this hour, we'll catch up with Stephen Parker of JP Morgan as tech revives a record rally. Clay Siegel of CSIS with oil steady as Iran tensions cool. And Jill Carey-Hall of Bank of America as the Russell 2000 outperforms the S&P 500 for a 10th consecutive day. We begin this out with stocks near all-time highs. Stephen Parker of JP Morgan with an S&P bull case of 8,200 by year-end, writing AI remains the defining force in markets. The momentum is broadening beyond hyperscalers and semiconductors into utility software and infrastructure. Stephen joins us now for more. Stephen, good morning.
Morning. Good to be here.
We've certainly seen this rally broaden out. Equal weight, record highs, small caps. We've talked about that run repeatedly throughout this morning. Is that just an early year rotation that loses steam or something you want to get behind for the year ahead?
No, we actually think that it has legs in the year ahead. Last year, as we talked about, was all about AI and technology, whether it was the economic growth, the capital spending, the earnings growth. This year, we think it's a story about broadening. We think that there is a cyclical recovery in the cards. We see that because we think labor markets will continue to stabilize and improve. You have easy monetary policy and tailwinds from fiscal policy. And I think that sets you up for a broadening of the growth story.
Is it a story that demands rate cuts? Or is it the fact that we don't get rate hikes and good growth and that's good enough?
Yeah, it's more the latter. I mean, our base case is we think that we get one additional cut in the course of this year, which is a little bit lower than what markets are pricing right now. And that's based on the idea that we think that growth is going to improve. Inflation remains a little bit sticky, but moves in the right direction. And so it's not predicated on rate cuts.
Within tech, can we just get into the pieces that are working and the pieces that aren't?
Yeah.
I can pick out a single name. I know you can't speak to it, but Microsoft has really underperformed. It's lagged. We haven't seen that pick up in that stock at all. Other software names you can identify too. What do you think is going on within technology stocks at the moment?
Yeah, one of the biggest challenges that we've seen within the tech space, and there was a lot of dispersion in terms of performance last year and continuing into this year. I think the software sector in particular is one where markets are pricing in some questions about what the impact of AI is going to look like for a lot of these software names. It's why we've been focused more on some of the hyperscalers, the semiconductors as the place that we would play. Ultimately, though, it's going to be the software companies, both public and private, that are going to be building the applications on top of this AI infrastructure. And we think over the coming years, that's going to be a key theme for our clients and our portfolios.
You have one line in your note that really stood out to me. While politics should not derail your plan, we must also recognize that policy can have a meaningful effect on fundamental drivers of growth and inflation. You're talking about these AI players. Companies like Microsoft are saying they are going to basically subsidize consumers' energy. Does that chip away at their margins?
Potentially, but I think not enough to stall the long-term growth prospects. In our 2026 outlook, we talked about three themes that we think are going to drive markets in the coming years. We talked about AI, we talked about inflation, and we talked about this idea of increasing global fragmentation. That's a little bit of what we're continuing to see play out in markets. And one of the key themes that we're talking about for 2026 is this idea of national champions and strategic industries. We've seen it around the world. Places like Europe are making a commitment to invest in their security and defense industries, and we're starting to see it here in the U.S. And we think that that commitment is real. We think that the fiscal spending is going to continue to pick up, and that those strategic industries are going to be beneficiaries of a lot of spending. That's an investable opportunity.
You want to invest in companies that the U.S. government might be taking equity stakes in?
We want to invest in industries that we think the U.S. government is going to consider strategically important. So think about things like industrials, utilities, companies related to the AI power story. We think there's going to be a massive amount of investment in those companies, both public and private, and therefore there's a fundamental story there.
Long term, though, do these companies do well? Doesn't this overall mean less competition?
I think we want to be careful about swinging too far away from the free markets that we've enjoyed and benefited from for so long. But I think there's also a recognition in that an increasingly fragmented world, there are certain parts of the economy and the market that are just so strategically important. We can't afford to outsource things like rare earth metals. And we're seeing that recommitment to investment here in the U.S., and we don't think that's necessarily a headwind to long-term growth and performance.
Listening to you, Stephen, just tracking what the governments are doing, I understand, I think we all do, they want to invest where the perceived constraints are going to be in the future. It sounds like you want to be alongside them potentially. Where are the so-called perceived overcapacity issues starting to already come up that are bumping up against those constraints? Where don't you want to be on this AI trade?
I think the places that we are more conservative around in the AI space, we are more conservative around the energy story. We talk about overcapacity. There's a lot of focus on power and the need for energy to power these data centers. We do think when you look, for example, at the price of oil, that's going to remain under pressure. There's huge amounts of oversupply in the market already. If Venezuela begins to come back online, that's potentially another boost to supply. And so energy is one of those places that some may consider a strategically important opportunity, part of the AI story, but not necessarily one that we see as compelling from an investment perspective.
Brent crude this morning, 64.57. Is that price a beneficiary to, say, the consumer trade at the moment? If you're short energy, are you long discretionary?
We do like discretionary, although you have to remember discretionary is a very diverse set of companies. Overall, one of the things that's important, you do have lower energy prices. You also have the tailwinds coming from one big beautiful bill, the fiscal stimulus, tax refunds that are coming. And so part of this broadening cyclical story is a boost to the consumer, which should be reinforced by that labor market stabilization that we also expect.
So when you think of the White House pushing out a lot of this affordability campaign, the president still talks about a tariff dividend, although I don't think we're going to get it. Consumer discretionary will do well. What else could do well in this affordability push?
I think the other thing that we're focused on as part of this, tax refunds give kind of the big headlines around this fiscal policy, but a lot of it also has to do with accelerated depreciation. And one of the things that we think is going to be a theme for this year is this ramp up in broader cyclical CapEx outside of just the AI story, which was the thing last year. And so when we think about industrials, when we think about the build out of infrastructure, that's another potential fiscal beneficiary that we think is compelling.
What about housing? Because there's a lot of emphasis on that right now by the president.
Yeah, I mean, housing is going to be one, there's a question this year, particularly leading into midterms, about how do you separate sort of the discourse versus what's actually going to happen. We expect that there's going to be lots of proposals, lots of headlines about potential policy. How much of that actually gets implemented remains a question, and historically that's been the case around elections. So we tend to be remiss to lean too much into specific policy actions and what it might mean. For the housing sector, there is a long-term structural problem. There is a supply-demand imbalance that needs to be addressed. Whether that's going to be something that plays out in the coming months, I'm a bit more skeptical.
Stephen, good to see you. Thanks for dropping by. Stephen Parker there of JP Morgan Private Bank. If you're just joining us, equities this morning, positive by 0.2% on the S&P 500 with an update on stories worldwide. Let's check base. Check up with Bloomberg's Vonnie Quinn for more. Hey, Vonnie.
Hey, John. Thank you. Ukrainian President Volodymyr Zelensky speaking in Kyiv today, saying that negotiators are heading to the United States to effort new security guarantees. President Zelensky says he hopes to finalize a deal soon, possibly even as early as next week at the World Economic Forum in Davos, Switzerland, where U.S. President Donald Trump is set to speak. Canadian Prime Minister Mark Carney is in China meeting with President Xi Jinping. It's the first visit by a Canadian leader in 8 years. Carney has been seeking to rebuild relations with Beijing and reduce Canada's reliance on the U.S. after President Donald Trump imposed sweeping tariffs. The two countries reaching a wide-ranging agreement to lower trade barriers. Netflix winning global rights to stream Sony's films after they complete their run in theaters and on pay-per-view. The deal expands an agreement first struck in 2021. The company is saying Sony Pictures will start appearing on Netflix this year as individual territory rights become available. That is your Bloomberg Brief. John.
Vonnie, thank you. Thank you very much. More from Vonnie in about 30 minutes' time. Up next on the programme, keeping one eye on Iran.
The president and his team have communicated to the Iranian regime that if the killing continues, there will be grave consequences. So the president and his team are closely monitoring this situation.
That's up next with Clay Siegel of CSIS, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
2 hours and 15 minutes away from the opening bell with equity futures positive here by 0.2% on the S&P 500, up by 0.5 on the Nasdaq, on the Russell. What a week again for the Russell 2000, a small caps higher by 0.3%. Under surveillance this morning, keeping one eye on Iran.
The president and his team have communicated to the Iranian regime that if the killing continues, there will be grave consequences. And the president received a message, as he revealed to all of you and the whole world yesterday, that the killing and the executions will stop. And the president understands today that 800 executions that were scheduled and supposed to take place yesterday were halted. And so the president and his team are closely monitoring this situation.
So here's the latest this morning. According to reports, the White House moving a carrier strike group to the Middle East. President Trump saying he'll hold off on attacking Iran after a crackdown on protests in the country. Bloomberg's Tyler Kendall joins us now for the latest. Good morning, Tyler.
Hey, John, good morning. Well, reports of this carrier strike group moving to the region comes on the heels of the Wall Street Journal reporting that President Trump has asked for the necessary military assets to be in place should he order a large-scale strike. Yet that report goes on to say that advisors have cautioned the president that a bigger attack is unlikely to cause the Iranian regime to fall. Bloomberg Economics say that the presence of a carrier strike group is likely a signaling tool. It wouldn't be needed if the U.S. were to pursue more tailored strikes or target leadership options we know are on the table, which is why our analysts are calling this all part of strategic ambiguity. And adding to that ambiguity, perhaps, is that we have seen a shift in tone from President Trump over the past week, appearing to narrow the possibility that an attack is imminent. After just earlier in the week, he had urged Iranians to continue protesting and pledged that help was on the way. But according to the president, he has received assurances that the killing is stopping. And as you heard the White House press secretary outlined there, a top Iranian official has pledged that they are not going to carry out planned executions. But John, we have really seen the death toll surge in Iran over the past 7 days. According to statistics cited by Bloomberg News from the Iran Human Rights Group, they are estimating that at least 3,400 protesters have died in what is considered to be the deadliest crackdown in the country in decades.
Absolutely horrific when it looks like that blackout continues, Tyler. We've also seen a lot of diplomacy. The Mossad director is in Washington, D.C., according to Axios, to meet with Steve Witkoff. You have Senator Lindsey Graham going over to Israel. Where is Congress in all of this? And can you give us a little bit of insight on some of these back-channel diplomatic dealings?
Well, it is also so interesting, Anne-Marie, because, of course, President Trump earlier this week said that he was canceling all meetings between U.S. and Iranian officials. But we know that there is this diplomacy going forward, as previous White House officials have suggested that that is always going to be an option on the table. Now, it depends who you talk to on Capitol Hill, but we have definitely heard from some perhaps more hawkish members. You mentioned Senator Lindsey Graham, who yesterday told reporters that he would prefer a bigger strike compared to targeted strikes, and to take this opportunity to capitalize on what has been this perhaps more interventionist sense from the Trump administration on the heels of what happened last week in Venezuela with the capture of Nicolas Maduro, and also President Trump's ramped up rhetoric when it comes to Greenland. It feels like we are talking about all of these different countries and possibilities in almost the same breath this week in terms of what the White House is going to do. It is clear, though, that no matter what President Trump does pursue, it appears that he does have the backing of Republicans on Capitol Hill, because
Anne-Marie, earlier this week, we did see Republicans walk back their support of a war powers resolution that would have curbed the president's authority when it comes to Venezuela. Of course, Iran is a very different story, but it just goes to say that he has been courting their support on the Hill for military intervention going forward.
Tyler, thank you. Thanks for catching up with us. Tyler Kendall there for the latest in Washington. Clay Siegel joins us now, Senior Fellow for Energy Security at CSIS. Clay, welcome to the program. Taken together, the developments in Venezuela, the potential for developments in Iran, is this energy positive or energy negative?
Hey, good morning, John. Well, it seems clear that there is more oil supply that is potentially coming into risk of disruption when we think about how the Trump administration is approaching some of these challenges around the world. I think that the oil market, conventional wisdom, has it right when it comes to Venezuela. The next big strategic move for oil in Venezuela is to have more supply in coming years. And obviously, that's a moderating effect on oil prices globally. In Iran, though, it's way too early to say what the next move is likely to be. And I see actually a high likelihood for at least some disruption of its 1.5 million barrels per day of exports to global markets.
What can that mean for the Brent price if we were to get serious disruptions because of what is going on in the Middle East?
Hey, Anne-Marie. Well, it means that there's definitely upside potential for Brent. And I think that the market will be looking, as always, to discount both the volume, the size of the potential disruption, and its duration. And we have to keep in mind that as we start the new year, oil market fundamentals globally look pretty ample. They look well supplied, some would say even a bit loose. And so we are expecting an overhang of supply relative to demand, at least for the first quarter. And so that does provide a bit more cushion, as does OPEC Plus's policy of, for the most part of last year, adding some supply to world market. And so we have adequate cushions for the time being. I think that you started to see a little bit of risk premium tick its way back into the market. So we got into the 60s for Brent, but kind of unwound as it looked like maybe the White House and Washington were taking pause, either to allow time for more resources to make their way into the region to give the president more options, or potentially more thinking on the strategic level, what military options really accomplish U.S. interests when it comes to supporting the populace in Iran.
Clay, how important is that energy cushion to the United States in these conversations at the Oval Office, whether or not they decide to take a strike on Iran?
Well, I think it has to be important. Naturally, we are entering campaign season in the United States, and eyes in Washington are starting to turn toward election season. So gasoline, fuel prices, and overall macroeconomic performance will be foremost on leaders' minds and politicians' minds. So no one's looking for a fuel price spike into 2026. But I do think that the overall ample supply relative to demand in the oil market gives a degree of cushion and probably allows policymakers to think about military options and other strategic options in a different way than we would if we were tighter. If you can imagine all the way back to 2022, after the Russian invasion of Ukraine, we had a very significant spike, thinking that Russian supplies could exit the market altogether. At the end of the day, they weren't removed from the market, they were just reshuffled. But those Russian supplies are still a target of policymakers. You were just mentioning Senator Graham in the colleague's last piece. You know, he and his partner, Senator Blumenthal, have been big advocates of cracking down on Putin's war chest, which comes largely through those oil revenues. And so these are some of the dynamics that are shaping leadership's views about how to handle these flashpoints around the world.
Given these flashpoints and disruptions we could see, not just from Iran, but to a great point, what's going on in Russia, can we get close to the president's target of $50 a barrel?
Well, that's going to be tricky. And I think that one of the important lessons that was learned from the first year of the administration is there's limited effect from policy initiatives on materially increasing supply. Last year was about the U.S. oil patch. So we started the administration with all the talking points that y'all know: drill, baby, drill, unleashing resources. To be sure, there are policy moves that can improve margins for E&P sector operators. But at the end of the day, it's not really up to politicians to determine how much is invested in increasing supply. It's about market sentiment, and it's about capital market decision-making, and it's about those investors, because investors are not as concerned about energy dominance. They want energy dividends. And if the break-even price of a new well in the United States is $65 a barrel, then targeting toward 50 is going to cause a lot of concern among those producers, and they're probably going to pull back some of that oil field activity. And I think the same goes for Venezuela. It's a similar concern. that if you don't have those break-even prices to be profitable in the coming years, it makes the investment case pretty challenging.
Clayton, I want to talk about another energy producer, and it's not Venezuela or Iran, it's Canada. Going into last year, I just had in mind this idea that we'd have this North American energy powerhouse. At the time, I was thinking maybe we'd end up with a conservative leader in Canada. Then things changed really quickly with the relationship between the US and Canada. Clay, this year, this week, you've had Canada basically align themselves to some extent with China. Clay, what's going to happen to Canadian energy?
Well, I think that a lot of attention has to be paid to the emerging dynamic between Ottawa and Washington. And if you think back even less than a year when we were talking about Liberation Day and other very aggressive tariff programs, it was conceivable that we were going to have a real rupture in the strong historic energy relationship between Canada and the United States. So our biggest supply of crude imports, it's not the Middle East, it's not other parts of the globe with these flashpoints, it's Canada, right? With more than 3 million barrels a day, adequately supplying those refineries in the Midwestern United States that are perfectly matched to Canada's type of crude oil. And so a lot for prices depends on whether or not we're able to keep right now, those supplies from Canada are kind of ring-fenced and off-limits for tariffs, everything under the UCMA. But we'll see whether the relationship between the Trump administration and various actors around the world, including Canada, can remain positive enough for energy to kind of stay out of the crosshairs.
Clay, it's good to see you. Thank you, sir. Clay Siegel there of CSIS. On that last point on Canada, the recipe's there, all the ingredients for a great relationship, and it just feels like it's still falling apart.
And the about face from Canada when it comes to what's going on with China, this new strategic partnership. Remember the previous administration with Trudeau? It was all-time low between Beijing and Ottawa when the extradition spat regarding that Huawei executive. This really feels like very new for these two countries.
It's an important development north of the border, that's for sure. Up next on the programme, Jill Carey Hall of Bank of America as small caps outperform to start the year. From New York, you're watching Bloomberg TV.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, Tuesdays only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
The new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Just about in the red for the week so far. Looking to change that at the opening bell. Equity futures positive here by 0.1% on the S&P 500, up by 0.5 on the Nasdaq, and the Russell doing okay, up 0.25%. That's how stocks are set up, 2 hours away from the opening bell. Let's get you some morning movers. Danny has more. Hey, Danny.
Hey, John. It still is those memory chip stocks that are dominating in this pre-market trade. Micron, easily the best performer in the S&P 500, the pre-market up 5.5%. SanDisk up 5.4%. It is this rally been ignited by the shortage of memory chip stocks and the huge premium, the cost that they are able to command. By the way, one of the board members of Micron also just put in a filing buying millions worth of the shares, also helping things out here. Micron's up something like 220% over the past year. It's not just memory chip stocks, it's the other AI-related equities that are doing well this morning too. The chip makers like NVIDIA, Intel, and TSMC continuing their rally after a strong set of earnings from TSMC yesterday, lifting the overall sector. Finally, another set of earnings. We got one from